After that Ofwat ruling on Thames Water, it's going to be put into special measures. Ofwat ruling coming in at the top of the hour. It's going to be an interesting session, Anna.
Absolutely. We'll keep an eye on what happens with those water companies as we go through the day then. All the politics, no doubt, will play out around that. But they didn't all of the players in that sector didn't all get what they asked for in terms of the return on equity they are able to give to investors. And that seems to be key. We'll get Jess Shankelman, our colleague who follows Thames Water very closely, on the programme a little bit later on. For the moment, though, we deal with the opening trade. 5 seconds to go until we get European equity markets opening up this morning. Let's have a look at whether we get that positivity, Lizzie, that you were talking about. So the DAX is open, pretty flat. The FTSE is open, pretty flat. So we have that upward momentum coming through from a late rally on Wall Street yesterday. That could send us a little higher. But at the same time, we're waiting for the CPI print. And on days where we get these big data prints, ones that options markets are really focused on, it can be tempting to sit on our hands and wait to see how this plays out. But we are seeing some modest gains across Europe, more than modest perhaps over in Germany. They're up by around 0.5%. The Stock 600 up by 0.2%. The FTSE 100 up by 0.25%. And we have the CAC 40 in the mix as well, up by 0.5%. So no French discount today when it comes to equity markets, at least. Lizzie, what do you see in terms of a deeper dive into markets this morning?
Yeah, if we look across sectors on the Stock 600, Anna, every single one of them in the green this morning. Technology leading the gains, up 0.4%. So continuing that mood from yesterday's session in the US. The sentiment very much here in the European session as well. Bottom of the basket is media, but it's just flat to the upside. Everybody, as I say, in positive territory this morning. I did say that we should be looking out for Severn Trent, and those shares are up 2.2% this morning. Novo Nordisk just slightly in the red. Crédit Agricole, we were talking about the M&A talks potentially with SocGen, with all the French election volatility in the background, and Crédit Ag's shares up 0.7% at the open.
Okay, yeah, interesting to watch what happens with technology stocks. The read across from the United States, never quite, 100% and direct across the Atlantic, but we do see tech stocks gaining a little. And yesterday, Lizzie, it was the tech stocks that were in focus, as we've mentioned a number of times. And once again, we find ourselves asking whether the earnings season in Europe, in the US, can live up to expectations, certainly for some of those big US tech names, whether they can really deliver on some of the things that they have been promising. Let's just play you what we heard from Peter Oppenheimer yesterday from Goldman Sachs. He joined us on set and had thoughts on the earnings season ahead.
Don't want growth to be too low either when confidence is so high about earnings coming into the second quarter. So I think the real catalyst for maybe some kind of softness in the equity market is any disappointment in the second quarter. Remember, expectations are running pretty high, and particularly so for the dominant stocks.
Chief Global Equity Strategist and Head of Macro Research for Europe at Goldman Sachs, Peter Oppenheimer, speaking to Bloomberg Television just yesterday. Let's get the thoughts of Helen Jewell, CIO for BlackRock Fundamental Equities EMEA, and Helen is with us on set. Hi, very good to see you this morning, Helen. Let's start with this sort of big picture question then around the earnings season and where that goes. We were just hearing there from Peter Oppenheimer that, if there are cracks in the equities strength story, then maybe they come from the earnings season. Is that your expectation?
Yeah, I mean, I absolutely agree with Peter there, where he talks about the need for the earnings to come through. All eyes are on earnings, and any disappointments will be penalised pretty hard. But where I would disagree with Peter is I don't think expectations are naturally too high. Actually, expectations came down, and then what we saw is earnings expectations increased by 1.5%. That is not a crazy re-rate in terms of earnings expectations. So I don't think that earnings expectations on the whole are too high, even though I do agree that any misses are likely to be penalised by the market, whilst we're in this kind of slightly cautious risk-on kind of environment that we're seeing right now.
And we've talked to you a number of times, Helen, about whether we see equity markets in Europe benefiting from that broadening out of the rally in the United States to the extent that we see it, and it tends to vary day by day. But we've been looking actually at where Europe has been performing as well as the US, and that's in a sort of broader measure of US stocks, but it's certainly not keeping up with the high flyers and the tech names. What's the latest thinking on how Europe does in catching up with what we've seen in the US?
Yeah, no, so that's going to be the key focus, and I think it's really difficult at the moment. You've got these few dominant stocks in the US that really are driving the market there. But we do still think that over the next 6 to 12 months, the breadth of what you see in Europe means that if you are going to see one or two of those names get hit, just by the law of averages, it's not going to be the same impact on the entire market than what you will see in the US if you do see that much narrower type of market get hit. So we do think that's a real positive for Europe. In addition, obviously, what you've got in Europe is the ECB have already cut. Now, today is going to be incredibly important in terms of that CPI print and in terms of what that indicates for any potential US rate cuts. But in Europe, we are still seeing the rate cuts starting to come through. On the flip side, we've seen geopolitical risk. You can never put that away. But there is no doubt in Europe, the breadth of the market is going to be a real advantage, I think, during the earnings season.
So that's the earnings picture, the central bank picture. But what about the politics? Is it actually casting a shadow over European equities, or will it if the uncertainty drags on?
Yeah, I think what the recent geopolitical risks has really done is just show why that valuation gap is there. So I think last time I was on, I was talking about the valuation gap shrinking. It did start to shrink. And then, Lizzie, guess what? It started to pull back again. And it is quite frustrating when you see that. I think we have to accept that in European markets, the equity risk premium is higher. And there is a reason that it is higher. It is the geopolitical risks. It's higher return names. But the earnings is the key thing in Europe that we need to remain focused on. And again, it's this breadth of earnings that we see within Europe that you don't necessarily see in the US that will give us that positivity in the next 6 to 12 months in the near term. So, no, I'm not going to say geopolitical risks have gone, but let's not overlook the earnings.
So they've not gone, but then if you break it down and you look within Europe, actually the UK's got some political stability. So does that actually make the UK a bit of a safe haven when it comes to equities?
Yeah, I mean, I think the UK is a really interesting story. The valuations are incredibly cheap, and there is no doubt what we're hearing and seeing from investors is they are looking at the UK once again. The political stability and the valuations, those two things combined means that the UK is of interest. I wouldn't necessarily call it a safe haven. I think that the entirety of Europe is really a safe haven because of the quality names and that breadth that you've got. So the UK is much more about the valuation story. I think actually more broadly in Europe, you've got some really, really interesting opportunities.
Well, I mean, you've been excited about the European construction sector for a while. I wonder, with all of the announcements on house building from the new Labour government, whether that makes you particularly excited about the UK construction sector.
Incredibly excited. And what I love about construction is you've got two things coming together. You've got the cyclical side of things. So the construction sector by its very nature is a very, very cyclical sector. On top of that, you've got the structural side. So from a structural perspective, construction, we need homes to live in. And what we're seeing is kind of a political stability that allows those homes to be built. So structurally, it looks interesting. And cyclically, it looks interesting. And that's a really interesting place to be.
We heard from the Bank of England's Hugh Pill yesterday. He was saying it's when, not if, we get that rate cut. But then we got that GDP data out this morning. It's just 1 month. But it's 0.4%, which is higher than 0.2%. You've got a government that's talking a lot about growth, growth, growth. Some of that will take time to deliver. Maybe some of that comes soon. I mean, we've got the football, lots of people spending money in the pubs. That'll be a short-term boost. But is there a risk that we don't get the rate cuts that many people are expecting in the UK, or we don't get it very soon? And that could be a risk again to that construction sector call.
I don't think. I mean, of course, there is a risk in terms of if interest rates get pushed back or interest rate cuts get pushed back incredibly, then I think that is going to be a little bit of a dampener on the markets. But I think it's really important we don't get too fixated by whether that is September, October, November, December, exactly when it is. And that's true for the US as well. There's going to be a lot of focus. Is it September? Is it later? The key thing is to Hugh's phrase, as long as it remains when, not if, And as long as it doesn't feel like we're going to be waiting 12 months, then let's not get too bogged down in the exact month of when that rate cut is going to come. The positivity, the feeling that inflation is coming back into control, that is what is going to give us that excitement in the market. And again, it is risk on, but it is cautious risk on. And I think that is what you're seeing when people are just navigating these data points as well. So let's not get too fixated on the exact month.
Well, let's just pick up on that, because after the GDP print, actually, you didn't see a change in the rate cut bets from the Bank of England. The move was more from Hugh Pill yesterday after his comments. But just, you're so optimistic, Helen. I need to find a little crack in it. What are the biggest headwinds on the horizon then?
I'm optimistic as well, because of England. It's given everybody a bit of a boost this morning. But the key risks do remain if inflation does remain stickier for longer. There is no doubt that we have to be very cautious that it goes back to this point. If interest rates do feel like they are a long way away in the US and in Europe, that is going to really put a bit of a sink on the market. The other key thing, going full circle back to the start and what Peter was saying yesterday, these earnings do need to come through. Any crack in those earnings, and I don't think we're going to see them, but of course you do see news flow. We've seen already some today. Any news flow that is not perfect or close to being perfect will be taken negatively by the market. That is the key concern that I have. And I sometimes feel I say every earnings season is important. It's why they're important. This earnings season is important to really show whether or not those earnings can come through. And if they don't, I think we will start to see a bit of a turn in the market.
It does feel like we were saying that last time. 3 months ago, Helen, we were saying, this earnings season is important because we need to see the likes of Nvidia justify its valuation, and then it did. We also asked whether we're going to see a broadening out of the AI trend. Is there anywhere in particular in Europe that you're looking to see more evidence of that? I mean, any company that supplies data centers, of course, is an obvious one. But when do we start to see the breadth of that AI impact coming through in the earnings stories?
Yeah, I mean, where it's really going to come through is in those data companies, utility companies, chip companies. We've got phenomenal chip companies here in Europe as well. We don't have that same level of breadth in terms of kind of direct exposure, but it is those secondary companies that we see. There's data companies in the UK as well, which are really interesting. So that's where the breadth is coming. But when I talk about breadth in Europe, it's not just breadth on AI, it's quality breadth across different sectors. And that's what I think makes it particularly interesting, is you're not just focused on AI, you've just got a much, much wider group of really interesting quality companies in Europe.
And you don't think that the questions around France, which we've asked many times of many guests, have always focused on, yes, short-term instability or uncertainty at least, but then these are big names with big exposures internationally. They're not a reflection of the French economy and all the policy making that you might see taking place at the National Assembly. Where do you stand on France and its sort of exposure to the rest of the world?
Absolutely. I think it's really important. It goes back a bit to Liz's point on the UK, to differentiate between the broad indices, which are very internationally focused, and the much more domestically aligned indices, and the separation that you see between the performance of those different indices. For us, a lot of where we're investing in France is in those international companies. And there, what we've seen in the pullback is real opportunities. What you see in the much more domestically focused indices, they are the ones that do need that political stability. We've seen in the UK that the performance of the FTSE 250 has been very interesting. So they are the ones that perhaps is a bit more of a wait and see until we see what that stability looks like. But really important to differentiate between the large cap quality names in France and the UK and generally in Europe versus the ones that are a little bit more domestically aligned. And they are the ones, of course, by very nature that are going to see the real kind of political impacts. But the valuations are so important. Look at the valuations that we continue to see in Europe. 13 times versus 21 times in the US. It's impossible to ignore that valuation gap, even if there are reasons for it.
OK, that's interesting. An interesting point to leave it on. We'll see what the earnings season delivers then in that regard. Helen, thank you for joining us this morning. Helen Jewell, CIO for BlackRock Fundamental Equities EMEA. Let's have a quick look at the Core 6. We've been talking about Novo Nordisk and how that business has been disappointed in the United States in the last 24 hours by some of the decisions around its weekly insulin treatment. That stock is down by 0.2%. We see a little bit of strength in LVMH, talking about international nature of the French market. A mixed bag, really, for the Core 6 this morning. Let's take a deeper dive into the individual stock moves. Joe Easton is back with us. Joe.
That's right, Anna. We go from the excitement of the football to the excitement of UK water regulation, because we have got a draft document out from the regulator out today on the amount of money that these companies can earn over the coming years. And it's actually looking better than expected today. We're seeing gains of around 6% in Pennon Group, also Severn Trent, United Utilities rising. There was potentially some concern that the profits would be constrained by the regulator, but that isn't the case, and markets are actually liking this. I've seen a Morgan Stanley note out saying this is very positive for the sector today, one of the best performing sectors we've got at the moment. We've also got some other earnings as well in the UK, a couple of decent movers I saw. There's DNB, we had that one in stocks to watch, better than expected net interest income, but also the bond market doing pretty well for that company over in Scandinavia as well, up almost 5% there. But Barry Callebaut dropping around 7%. That's the biggest decline in about 5 years for one of Switzerland's biggest chocolate makers. The thing for them is the higher cocoa bean price. That's what they're saying, really hurting their profits this morning. We've also got Hayes. This is in recruitment. It follows Page Group earlier this week with a bit of a profit warning from them, saying a very similar thing, actually, declining fees in the recruitment market, hitting that sector at the moment. And finally, Jet2 down the bottom here, the package holiday company. Actually, some interesting comments around people taking longer to decide on when to book their holidays, but that is not actually feeding into the stock, seeing a bit of a gain. The bookings remain reasonably strong at the moment. Then we'll take a look at Novo, coming down only very slightly. The FDA not approving this weekly insulin shot for the company that had been approved in other markets, but that stock really driven by the obesity thesis at the moment, so not doing too badly, only down at 0.2% at the moment. We'll check in on the French lenders. We did get that news of Credit Ag looking at SocGen's German consumer finance business, according to a Bloomberg exclusive. That's worth around 600 million euros. That stock gaining 0.7%. Credit Ag also very slightly higher today. Couple of morning calls to bring you. Firstly, we're going to look at the train sector. Alstom gets an upgrade at JP Morgan. They reckon the decline on capital concerns at the French company is overdone, so they reckon you should be buying that one at 21.80 euros. It's at almost 17 now, so decent upside for that one. And finally, another upgrade today is Novartis. This one is upgraded at Oddo. We're gaining 1.5%. They think the cancer profile of the company will continue to boom in terms of their oncology treatments, and that stock is gaining today. Novartis up 1.5% in Switzerland.
All right, Joe Easton, we thank you for that look at the stocks to watch at the open. The movers, as we are quarter of an hour into the session, the stock 600 higher 0.2%. You've got more sectors actually inching into negative territory now: autos and parts, energy, media, basic resources. But really good of Joe to talk about the utilities and water, the impact of this ruling by Ofwat, the UK water regulator, on Thames Water, I should say. Actually, Severn Trent and United Utilities, as he says, benefiting from that. But just across the terminal, we do have the possibility that Thames Water, which is, of course, the biggest water and sewage company in the UK, could be broken up. It could be listed on the stock exchange. It could be forced to cap its debt under these special measures that have been set out by the regulator. So we're going to be talking more about that in the next part of the programme, and a very big question as well for this new Labour government, how they're going to deal with it. I know you talked to the business secretary, the shadow business secretary as he was, when you did the Jonathan Reynolds at our UK business election debate about the potential nationalisation. Let's talk about those policy measures, but also how the company is going to handle this. That is what's coming up next on the programme, tightening the pressure gauge as Thames Water's placed under this special regime to save it from collapse. Stay with us for that conversation. This is Bloomberg.
To the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
Welcome back to the opening trade. We're 20 minutes into the cash session here in Europe, and the positive mood has spilled over the Atlantic into the European session. The stock 600 higher 0.1% currently. That positive mood from the tech record-breaking session on the S&P yesterday is here this morning. Only about 5 sectors in negative territory this morning. Consumer products and services leading the gains, but we have had an important ruling this morning from the UK regulator on water. This is Ofwat and Thames Water, it says, is to be placed under a turnaround. The oversight regime to help lift the UK's biggest water and sewage company out of crisis. UK regulator Ofwat also set limits on returns and price rises for consumers. And to talk us through the significance and go through all the details with us is Bloomberg's Jess Shankelman. She's been covering every twist and turn of this story. So Jess, you've been through the document. What's your main takeaway?
Yeah, the big surprise today was Thames Water being put in special measures. Obviously, there's still proposals, but it's quite likely to happen under Ofwat's proposals. We've got a new Labour government that has said it wants to put failing water companies into special measures. Thames is taking steps to try and tackle chronic leaks and sewage spills, but it is still, according to the latest documents, a failing company. It's lagging behind all the others, and it's incurring penalties on that. So under the plans proposed by Ofwat, they could put in an independent monitor that would have access to all of Thames' documents, and it could break up the company, it could force an IPO, or it could cap the level of debt. Thames is obviously the highest indebted company of all the 16 water and sewage companies in the UK.
So that's what special measures could mean then for the business. It seems like there's a lot of different options, a lot of different directions this could go. For the future of the business, they're going to want investors and investment. The return on equity rate that is regulated by the regulator was seen as key. So what has Ofwat indicated they're going to allow businesses like Thames to return to investors?
Right, yeah. So Ofwat sets the return on equity, the return on debt, and together they make the WACC, which is the weighted average cost of capital. Thames said it needed a return on equity of 5.7% to make it attractive to get new investors. Obviously, their investors, their current shareholders, walked away from the business at the end of March. They said the business plan is uninvestable. Ofwat has set regulations that are too tight and we can't do this. So Thames said we need 5.7%. Ofwat said 4.8%, which doesn't look like it's going to be enough, but obviously it kind of remains to be seen, because there is definitely a lot of brinkmanship going on at the moment. You know, a lot of people thought, even with the shareholders walking away, were they genuinely walking away, or was it a game to try and push off what into giving them an easier time and adding some leniency?
It's interesting, that return on equity point, Lizzie, because this is all in a new regime of higher interest rates. So then if interest rates start to come down, to Jess's point, that'll have an impact on the return on equity and the weighted average cost of capital that businesses will require when they invest in Thames. So that's why there's such a focus on this particular dynamic.
Yeah, and of course, with interest rates coming down, it brings us to the consumer angle on this. We're getting to the tail end, it would seem, of a cost of living crisis, but a crucial part of Thames Water's plan that was being ruled on by Ofwat here was how much prices could be increased. What's been the ruling, Jess? And, you know, what are the consumer groups reacting to this? Are they mad?
We haven't had any reactions so far, but I can guarantee they are going to be very angry. The water companies are going to be very unhappy that they've had their investment plans cut back and their proposals for bill rises cut back. The consumer groups are going to be very angry that we're going to see bill increases at all. Just to put this in context, since privatisation in the 1990s, the focus has always been on low bills, and we've traditionally had very low water bills in the UK, perhaps not really reflecting the true price of water. Now, in the past 5-6 years, we've seen a huge focus on pollution, environment, the need for water companies to tackle sewage, to tackle chronic leaks, and that means that the bills will have to rise. So Ofwat has cut back the proposals from investors, and they're saying that on average bills are going to rise by about £19 a year over the next 5 years.
So we know that Thames Water is going to be put in this turnaround oversight regime, and you've referenced some of the different paths it could take. I mean, where does this leave the business? What is likely to happen to Thames Water?
Yep, so this is all crucial for Thames Water. They need to raise new equity. Chris Weston, the CEO, was talking on Tuesday at their annual results, saying we could run out of money by June next year if we can't find new equity, and that could very easily happen, because if Thames is unhappy with the proposals that Ofwat's made, we're not going to have a full final decision until December. This is only a draft decision today. It's possible that Thames and other businesses could appeal the ruling to the Competition and Markets Authority, which could drag on for a year, which means that it could be very difficult for Thames to get a deal with a new equity provider while that's ongoing.
Okay. And have they said anything about pay and CEO pay? Because I know for a lot of journalists covering this story, that has been a key area of focus.
Well, it has, and on Tuesday it was revealed that Chris Weston, who joined Thames in January, has already received a bonus of £190 million for doing really well at running this failing business. And there was obviously a lot of anger around that. Ofwat hasn't said anything about bonuses specifically today, but the government has said that it's going to crack down on bonuses and make sure that if there is any money left over that companies had said they would spend on infrastructure, they're not siphoning that off to pay bonuses, pay increases and dividends.
Jess, thank you very much. A complex story, and Jess all over the details, so we thank you for coming to explain it to us. Jess Shankelman from Bloomberg News with the details on Thames Water. Coming up on the programme, we'll be back to talking about technology. Don't miss our exclusive interview with Lightspeed Venture Capital's boss. He's going to be joining us shortly. That's from the Bank of America Breakthrough Technology event. A really interesting day for Tom McKenzie to be down there in Sussex at this technology-focused event. We've heard from the FCA about how they want to change listing rules, perhaps to attract more tech listings into the UK market. I wonder if that's something that's being talked about down at Goodwood. That conversation coming up shortly. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is the opening trade, 30 minutes into today's session, and European equity markets making modest gains as we wait for the CPI print out of the United States later on today. That is going to be the focus for markets. Will that set the stage for a rate cut in September? Could it come as early as September? That is what the market is asking itself right now. One sector in focus today is the water sector, very dependent on where we go on interest rates. And just to correct something we said in the last part of the programme, the bonus taken by the CEO of Thames Water was £195,000. This was for the 3 months to the end of March, taking his total pay to £437,000. So those are the numbers that we should have mentioned in our last conversation when it comes to CEO pay. Let's put that sector to one side and bring technology into sharper focus. We are, this morning, Tom McKenzie is at the Bank of America Breakthrough Technology Dialogue event. That's taking place in Sussex. It brings together more than 50 of the world's top CEOs, innovators, and other key players involved in new technologies. And Tom McKenzie is there at Goodwood in the UK for an important conversation around the UK and tech. Tom.
Anna, thank you. Yes, very pleased to say I am now joined within that mist, the executives, the VC founders, of course, the bankers as well from Bank of America, of course, now joined by Bejul Somaya. He is partner at Lightspeed Venture Partners, also co-leading the business as well. Lightspeed has about $30 billion of AUM, of assets under management. And Bejul, unsurprisingly, a big part of the conversation last night at this event, leading up to this event, and this morning as well, has been around generative AI and how to think about the impact of that. As we look across the AI stack, where it's the hardware, the chips, the data centers, the foundation models that are built on top of those, or the applications on top of the foundation models, where within that stack is Lightspeed looking for opportunities right now?
Yeah, morning, Tom. Well, I think the starting point is always the infrastructure. Without the infrastructure, we can't really build things on top of it. And so a lot of the investment last year in the industry generally, and including Lightspeed, was at the foundation model layer. OpenAI, obviously, we're investors in a company called Anthropic on the proprietary model side, and then in a company called Mistral on the open source side. Because I think we will see roles for both proprietary models as well as open source models. What we also see then, these are the general purpose horizontal models. There are certain use cases of formats that we believe may require vertical specific models being built all the way through to the application layer. An example would be a company like Suno, which is arguably changing the world of music creation through a combination of foundation models and then user-facing applications. So that's been sort of a little bit of the first generation of companies. The next question is really, how will enterprises use these models? How will they use their data? They can't just wave a magic wand. There's a whole stack that's really got to get built. And we're thinking a lot about what this enterprise stack looks like in an AI-native world.
Okay.
And so everything from databases to security, testing, prompt engineering, data governance, data management, and which parts of that may be won by incumbents, and which parts of that stack will need net new companies to be built. And so the tooling and platform layers are now where we're spending a lot of our time.
Okay, that's very interesting. And that's the focus because, of course, as you say, you've invested in Mistral and Anthropic, two really, really big names in terms of the world of in the world of foundation models. Are you concerned that there's a bit of a commoditization coming in for those foundation models? I was speaking to Jonas Androulis of Aleph Alpha, based in Germany, also a large language model, and he says, how does OpenAI actually turn a profit? There is a commoditization effect going on.
Yes.
Is that a concern?
Well, look, what we're obviously seeing, and I think we would have anticipated seeing, is API call pricing coming down. Now, I think the most dangerous, our perspective is perhaps the most dangerous perspective to have at times like this when technologies are changing so rapidly, is to think that we know what the answer is going to be. We don't, right? But here's what we believe, which is that in a world in which the volume of calls expands exponentially, which we will see as more and more enterprises adopt generative AI. And now if you think about an agentic world, where each of us may have multiple agents operating on our behalf, and enterprises will have agents operating on their behalf, also making calls, well, then the volume of calls that are made on these foundation models is going to be absolutely massive, right? And so while the price per call may come down, the volume of calls will be extremely high, and we expect compute costs to decline. And so I would argue, in that world, these companies at scale will absolutely be able to make a profit, right? But we don't know. These are things that we don't know, but I think it's dangerous to be too rigid with a particular point of view, and we're remaining open-minded about all of these possibilities.
Is there pressure that you put on some of these companies around monetization? Are you getting to that point where you're having those conversations? You need to start monetizing some of these products.
Well, look, I think these founding teams recognize, given the cost of compute and the capital intensity of these businesses, there's only two ways you can manage the capital intensity. One is you will keep raising capital. The other is you've got to earn revenue. And I think the answer will be both. You can't rely on the capital markets. The private markets have embraced these companies so far, right, with these companies raising billions of dollars, and most recently XAI raising close to $7 billion. So capital is available. But you can't assume that will always be the case. And I think we're beginning to see companies like OpenAI and Anthropic begin to scale revenue very fast.
Okay, interesting. In terms of the venture capital world and the structure within that sector, so Lightspeed's done something really interesting, which is looking at this continuation fund, so essentially allowing investors to take about $1 billion of stakes in your portfolio companies, so freeing up about $1 billion across the portfolio. It's a PE-style structure. What is the rationale behind that?
Yeah, the rationale behind that is that companies are staying private for longer. And at the same time, we want to be able to support those companies, yet recognize that some of our LPs that are investors in the funds that are invested in those companies, it's important to drive liquidity back to them. And so how do we solve both of those problems? Well, it is, for example, to take a set of what are still very healthy companies that are compounding in value and put them into what we call a continuation vehicle, where the underlying LP base may change, right? That provides liquidity to LPs that want it. Others may not, and they can roll over. And it enables Lightspeed to continue to steward those positions and continue to be a partner to those companies.
I know that you spend a lot of time in India, Southeast Asia, but India is part of that mix as well, yes, in terms of the region for you, and it's an important market. There have been some challenges for some of the startups there. I'm thinking of Baidu, for example, once India's most valuable startup, now challenged in terms of whether it can even survive. Paytm as well, in something of a crisis. Is the VC community turning sour on startups in India?
I think the headline is it isn't, but these kinds of episodes are always sort of they make a dent in the ecosystem, right? But it forces you to ask the question of what's really happening here. And when you look at the political stability in India, when you look at the macros in India, when you look at public market stock performance in India, You look at central bank management around interest rates and inflation. All of those continue to be very strong. You look at underlying company creation, digital adoption, quality of founders. You know, we've got to be first principles, and all of those foundations of the economy are quite strong. And so I think these are bumps in the road. They happen in all economies, and we remain quite optimistic.
So above and beyond India, more broadly, when do you see a turnaround in exits? When do IPOs come back? When do the public markets start to give a lift?
I wish I had a crystal ball. Yeah. You know, we were fortunate to take one of our companies, Rubrik, public earlier this year. A strong company. It's a reminder that the public markets are open for good companies, but that the bar to get public has gone up. And so I think the way we think about this at Lightspeed is we can't assume that the public markets will reopen. They will enable the best companies to get public. But we have to be creative and thoughtful about driving liquidity to our LPs. And there's a range of ways we can think about that and have to be thinking about it. I don't think the venture capital industry can continue to assume that liquidity will happen to us in the way that perhaps the industry operated 10 or 15 years ago.
Okay, Bajal Samaya, thank you very much indeed. Partner at Lightspeed Venture Partners, co-leading the business, again, AUM of around $30 billion US. Some really interesting, of course, investments in the likes of Mistral over in France, Anthropic, of course, in the US, Nest, Rubrik, and a ton of others, of course. Really consequential in terms of the startup space and the view around liquidity in those public markets, maybe not coming back quite yet, guys.
An excellent conversation. Bloomberg Tom McKenzie, our daybreak anchor at the Bank of America Breakthrough Technology Dialogue event. We thank you for that conversation. And really interesting to get the investor mood there from Lightspeed on IPOs globally and here in the UK. And it's what we're going to be talking about next. We'll talk about the overhaul of the listing rules here in the UK by the Financial Conduct Authority, the regulator. Just to bring you some statistics, according to the latest UK listing review, the number of listed companies in the UK is fallen about 40% from a peak in 2008. So can these new rules turn the situation around? We're going to be speaking to Sarah Pritchard, the Executive Director for Markets and International at the FCA next. So stay with us. This is Bloomberg.
Also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We've definitely seen some opening, absolutely. We saw the Aramco deal in Saudi, we saw an accelerated book build by London Stock Exchange here, and we're seeing activity in the US. So absolutely more than last year, and we've seen that in Q1 and Q2. The question is, does it continue through Q3 and Q4? Who knows? There are big election cycles. Sometimes people are a little bit cautious ahead of that. But at the same time, the central bank's posture will give boardrooms confidence.
That was Bank of America's President of International, Bernard Mensah, speaking to Tom McKenzie a little bit earlier, talking about return of confidence in capital markets activity and a rebound in capital markets activity, better than last year, at least seems to be the way that he was describing it. Where does that leave the listings environment around the world? Well, the UK is hoping to play a bigger role in that listings story. UK regulators are set to overhaul their rules for companies looking to make their public debut in London. This is part of the FCA's effort to draw more IPOs to the city. What can be done? What do the rules involve? Sarah Pritchard joins us, Executive Director for Markets and International at the UK's Financial Conduct Authority. Sarah, very nice to speak to you. Thank you for joining us. I wonder how you would characterise the change in rules today. Would it be right to say it's a necessary but not sufficient step towards levelling the playing field for IPOs between London and other parts of the world? Is this enough for the London market to catch up with the rest of the world?
Well, thank you, Anna, and thank you for having me to explain what are the biggest changes to the UK listing regime in over 3 decades. What we're seeking to do today is to announce a simplified regime that maintains high standards, that compares well internationally, and looks to help boost UK stock markets. We want to see a regime that is right for the UK and internationally competitive.
Right, yes, so you want to see that, but is this enough? Is this going to close the gap? I mean, you're doing what you can, I suppose, from a regulatory point of view, but should we expect more to come? I was interested to see that Labour and the Conservatives both said ahead of the election, after you put out your draft rules, that this wouldn't necessarily be enough and they were looking for regulators to do more. Is there more to come on this front?
So what we've done today is we've very much reduced some of the frictions that we've heard from corporates that get in the way, that are barriers to some entities considering the UK as a destination to list. So we're very much looking to simplify and reduce some of those frictions. So my message to companies that might be listening is, if you're considering the UK and you don't know what these rule changes mean for you, please do go and speak to your advisors, go and speak to some sponsors, come and speak to us. If you would like to, these rules will come in at pace on the 29th of July. It is quite important to emphasise, though, that clearly this rule set is part of a broader regulatory regime, and we've said that throughout. This is us playing our part in ensuring the strength of UK capital markets, but there are other dynamics at play, and this is part of a broader ecosystem. Others will also need to play their part too.
Who are those others that need to pull their weight, Sarah? Have you already met with the new City Minister, Tulip Siddiq?
So we're very clear that these rules by themselves are part of a broader ecosystem. There are other factors at play, clearly, in companies when they decide to list, the availability of skills, the availability of capital, familiarity with the sector. What we are seeking to do through the rule set is remove some of the frictions that we do know and we have heard get in the way. We're looking to move to a very disclosure-based system so that information is in the hands of investors, so that investors can make their own decisions on where to invest. And we look forward to continuing to play our part as the FCA through future regulatory reform on the other elements where we can contribute, One of the things to signal upcoming is that we have a future consultation coming out in the summer on a revised prospectus regime, which is part of our broader remit that we are, as the regulator, playing our part.
And so how quickly do you expect these rules to actually make a difference to the London IPO market? How are you going to measure that success?
Well, I think here success clearly can't be measured in days or weeks. This long-term success of the UK's capital markets, healthy capital markets, is what we are looking for. But clearly, we would hope to see an increased number of companies consider the UK to list. We'd hope to see a broader range of opportunities for investors, so a more diversified market. What we have said that we will do in the rules that we've announced today, as you say, coming in at pace within a couple of weeks, so we'll be live from the 29th of July. We have also said that we will formally review these rules in 5 years' time too.
You've said in your release this morning, Sarah, or overnight, the regulator has acknowledged that it's aware that some market participants won't be happy with this decision. In particular, one of the decisions not requiring companies to seek shareholder approval for significant and related party transactions. Who have you had feedback from? Which parts of the market will not be happy, do you think, with that particular new option, new development?
So what I would like to say first up is we are really grateful for all of the engagement that we have had throughout a really extended consultation process. We consulted through 2 consultations last year in May and December, and we've had extensive engagement directly and through the consultation process with a number of different parties. Broadly speaking, we see real support for the simplification of a single regime, but there are a few areas where there's been a split between sell-side views and perhaps buy-side views on some of those elements, significant transactions, related party transactions, and dual-class share structures. What we have sought to do, though, is to make sure that we are very clear in the market notifications that we will be requiring that the right information is in the hands of investors so that they can make decisions. We believe that a lot of those companies will have the heft to steer the companies that they own. One of the things that we will be looking to in terms of signs of success will also be the increase in that type of engagement between boards and the shareholders in terms of the decisions of significance that you've highlighted.
Sarah, so that's interesting. Sarah, in terms of what you've announced, you've referenced there the dual class of shares. Typically, that's quite attractive to early stage technology businesses. I wonder if this is a set of rules that is designed to attract technology businesses. Is there a risk that you end up losing maybe some names in other sectors? Some have said that London should focus more on retaining the businesses it has rather than attracting new ones. What would you respond to that?
So what we're doing through our rule set is allowing for choice and flexibility. We are not mandating dual-class share structures, but we are permitting them through the rule set. We quite expect that market dynamics and market forces will determine on a case-by-case basis where dual-class share structures are appropriate or where investors have the intention to invest knowingly in a company that has dual-class share structures. They are already permitted under our standard listing segment, so the change here through the simplification of bringing those 2 segments together into a streamlined, simplified single segment is to give greater possibility for dual-class share structures to be used, but we fully expect these to be negotiated and investors to make their own decisions then in terms of whether they're prepared to invest.
Sarah, thank you very much. Thanks for your time. Sarah Pritchard, Executive Director for Markets and International at the UK's Financial Conduct Authority. So that's the regulatory conversation of the moment. The political conversation is stateside, a focus on world leaders, certainly NATO members gathering in Washington. In that context, Joe Biden under scrutiny, of course, for his performance recently. His candidacy faces mounting pressure after Vermont's Peter Welch becomes the first current Democratic senator to call for the president's withdrawal. Axios has also been reporting that the Senate Majority Leader Chuck Schumer is now open to replacing the commander-in-chief, even though he publicly has been saying that he still backs Joe. This as Biden heads into his final day at the Washington NATO summit, and a press conference awaits him later. For more, let's bring in Bloomberg's Derek Wallbank, who has followed US politics for many years. Derek, good to see you. So it seems like Biden's NATO speech today and his press conference is going to be in focus. What's going to be, what are the things to watch for you?
You know, Anna, I think this is one of those times, you know, sometimes we look at these situations and you say, oh, I need to look at this detailed thing, or there's this thing over here, and this isn't one of those times, is it? This is one where everybody's looking at the exact same thing. What does Biden look like? How's he doing? Does this give you an impression that this is the guy who's got what it takes to go beat Donald Trump? Look, Democrats are candidly scared that Donald Trump may win election again. They are worried about what that would do, and they want someone who can win. It's an overarching thing among Democrats. They want win over purity. They're willing to compromise to get that. But that debate left a lot of people with a doubt in their mind about whether or not Joe Biden could prosecute that case against Donald Trump, and about whether he was the man for this moment. And that's what's led to these calls, right? Is that real clear question, is this the person? You know, Michael Bennet, a senator from Colorado, who has not yet called on Biden to step out, but has suggested that he have a think about his options, said that he's really worried that Democrats right now are on pace for Trump to not just win, but to take the Senate and House as well.
Yeah, I mean, this cast of voices just keeps mounting day by day. Schumer, Pelosi, Clooney. Are we getting to the critical mass, Derek, where it just becomes a question of when, not if, for Joe Biden?
Well, see, here's the thing that I think is different about this situation than most others, is that Joe Biden holds all the cards. He won all the states in the primary process. He has the delegates. He is the nominee unless Joe Biden, in his sole discretion, decides that he's not. So this is not a situation where party grand poobahs can walk up to him and say, oh, well, you know, it's your time to exit. That's not really a thing here. This is a situation where someone has to convince Biden that he needs to go. And one of the things that I think is actually interesting is that there may be some folks who are worried that going out and saying that might cause Biden to want to stay in more. So they're trying to be a little bit careful. There certainly are a lot of people, I think maybe a majority in the Democratic Party, that hope that Biden comes to whatever the conclusion is on his own. We shall see if that happens. But look, Biden has the cards. It's not like a George Clooney or a major donor or even a Nancy Pelosi is going to be the one to say you're out and then he's out. Joe Biden is the one who gets to make that decision. And let's be really clear. The thing that we're talking about as an overarching event isn't just a random press conference. This is a NATO summit. This is a Zelensky is in town and we're talking about how to save Ukraine moment, right? This is a what message are we giving to Russia? What message are we giving to China moment? So there are other things going on. There are conversations this White House wants to have that are not, can Joe Biden string a sentence together? That's not what they want to be talking about right now. They want to be talking about the world's urgent problems. Yeah. But instead, there's going to be a press conference where people are going to be focused on optics more than words, for better or worse.
Derek, thank you so much. Bloomberg's Derek Warbank with all the important context around, you know, it's a press conference later on, Lizzie, about the NATO summit, but it's actually much more than that. It's a check on how the President of the United States is performing and how fit for office he is another time round. These are the events happening today. What stands out to us? Yes, some earnings, some Fed speak, but US CPI, that's going to be the focus.
Yeah, the focus for markets very much. We had the Fed speak from Jerome Powell yesterday, setting the stage for that September cut, not changing the bets really, but does this CPI print actually change the narrative? Of course, the focus very much on the core number that drops at 1:30 p.m. London time. Also on the jobs numbers, because again there, Jay Powell expressing his concerns about the labour market.
Yeah, absolutely. And we know that the Fed watches the PCE, but we are expecting that year-on-year CPI number to drop down from 3.3 to 3.1. Will that be enough for September? Stocks in Europe, meanwhile, rallying in the green. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep
Green World Cup. This is a three
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Pressure mounts on President Biden to drop his re-election bid as a Senate Democrat calls for him to drop out while former House Speaker Nancy Pelosi weighs in. Plus, Fed Chair Jay Powell gives a cautious outlook on the inflation battle as a tech-fueled rally continues ahead of key U.S. data today. Plus, a boost for the UK's new government as the British economy expands at double the pace expected in May. All of the analysis in our weekly UK show at 9:30. Now, first thing is first, so let's take a look at the European markets map. Now, a lot of these European markets are rising, not as much as we saw in Asia, and again, that was fueled by the tech rally that we saw in the U.S. You can see the CAC 40 gaining some 0.5%, the DAX at 0.2% higher again. It's all about that key U.S. inflation data, and when you look at what they're expecting, traders are expecting that core CPI reading to be around 0.2% higher in June. Now, this is across assets, so we look at U.S. 10-year yield. This also has to do with the presidential election and the fact that there are many more cries for Joe Biden to step down. S&P futures practically flat, euro dollar 1.0840, and then gold at 2,380. We're also getting the recap on what the IEA says on global oil demand, and they see that slowing further as they see China continuing to cool. That's not having a huge impact. A lot of it was priced in on the price of oil, but you can see Brent and actually WTI both gaining some 0.4%. So for the markets and the conversations that matter, the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, we've got top interviews to bring you this hour, including an exclusive with the Ralph Lauren chief executive, Patrice Louvet, on the luxury label's outlook and its relationship with one of the world's most famous sporting events. Yes, we talk Wimbledon. Now, European stocks higher this morning ahead of that key U.S. inflation data due out later tonight. So let's get more from Bloomberg's Justina Lee. Justina, thank you so much for joining us. It's been a busy week. So we heard from Powell, we heard on inflation, and then finally, ta-da, CPI later on.
I know, we had some pretty helpful remarks from Jay Powell there, so we really just need this set of CPI numbers to play ball. And if you look at what economists are expecting, a 0.2 month-on-month increase in the core CPI, which would be the smallest back-to-back increase since August. So if those are the numbers that we get, it would be an extension of what Jerome Powell called really good numbers. And I think that really puts us on the track for a Fed rate cut in September.
So is that why, when you look at indices in the U.S., they keep on pushing higher? Is it on expectations of a Fed cut, or is it more really the forever tech rally?
I think it's a bit of both. I mean, you can say that we are still in this nice Goldilocks scenario where there aren't like really serious signs of an economic slowdown, but definitely growing confidence that we will get that Fed rate cut, you know, just before kind of any more severe contraction in demand. But at the same time, it's kind of interesting that a lot of people have been talking about the growing concentration in the U.S. market. So that just raised the question. I mean, is it really about the economy, or is it really about, you know, those 7 stocks?
And so what else are you watching out for today? I mean, we had UK data, which was a little bit better than expected. France, a lot of question marks over the coalition and the next government.
Yeah, the UK is interesting because obviously we've kind of had a bit of move in the probability of a rate cut recently, in that we've heard some pretty hawkish comments from BOE officials, and now this GDP number, which suggests that the economy could be running hotter than we previously thought.
Justina, thank you so much. Justina Lee there with some of the big market moves that we're watching out for today. Now, Joe Biden's candidacy is facing mounting pressure after Vermont's Peter Welch became the first Democratic senator to call for the president's withdrawal. Axios is reporting that Senate Majority Leader Chuck Schumer is also open to replacing the commander-in-chief. Now, this comes as Biden heads into his final day at the Washington NATO summit. So for more on all of this, let's bring in Bloomberg's Kevin Whitelaw, who's in Brussels. Kevin, it feels like the pressure is mounting. How much do the new calls for Biden to step aside actually hurt him?
I mean, you know, it's just drip, drip, drip for Biden, who's just been simply unable to shift the narrative on this, you know, with everyone out there looking for a misstep, everyone looking for some sign that he's just not up to the task. And the fact is, every single one of these is hurting him because it is just not allowing him to turn the page. No matter how many times he said, I'm staying in, obviously, Democrats are increasingly worried. And I think having a senator like Peter Welch come out and make this call explicitly, say it's time to do it, it hurts a lot. And it has the potential to sort of just open up the floodgates for concerns that we know are flying around in private in both chambers of Congress among Democrats.
So, Kevin, what happens next? Can he stay on? Does a good performance at NATO actually make a difference, or is it just a matter of time?
Yeah, I mean, he goes out and gives a good speech, and then, you know, that doesn't necessarily by itself. No one day is going to undo that debate performance. And then also, I think what we've learned is it's not the only time that people have seen him in a situation that shows worrying signs of age. And indeed, when the actor George Clooney just called on Biden to also step down from his reelection bid, he said that he was seeing some of those same signs at a fundraiser he recently hosted. And so I think you're starting to understand that there's a broader trend here. I think it would take weeks and weeks of really strong performances to begin to undo that narrative, and it would only take 1 or 2 more stumbles to fully cement it.
So, Kevin, can the Democratic Party actually push him out? After all, he's president, so it seems extremely difficult without resorting to, you know, extreme measures. Or is it really up to Joe Biden to decide?
I do think it's really up to Joe Biden to decide. I mean, we're in incredibly uncharted territory when it comes to sort of the political landscape in Washington. This really would be almost without precedent kind of event for him to step aside. And I can't imagine a scenario where they try to unite and somehow push him out. He won primaries. He had, you know, millions of Democrats vote for him. And so I think it is ultimately up to him. He's a guy who, in 2020, thought he was absolutely the best person, maybe the only person who could defeat Donald Trump, and he did manage to do that. I think so far the president still thinks he still has the best chance of defeating Donald Trump. It's just not clear that many other Democrats agree anymore.
Kevin, thank you so much. Kevin Whitelaw there in Brussels with a terrific roundup of what's going on in the U.S. Now, coming up, an exclusive conversation with the chief executive of Ralph Lauren on the future of the luxury sector. We'll also discuss Wimbledon ahead of the finals this weekend. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back, everyone. This is The Pulse. Now, Bloomberg Intelligence says Ralph Lauren is moving closer to ultra-luxury names such as Louis Vuitton or Prada as the company focuses on timeless merchandise across fashion, music, gaming, home, and sports. Now, that last category is in the spotlight, with the company remaining the official outfitter to Wimbledon ahead of the finals this weekend. Now, the company's shares are also having a strong year so far, up around 24% amid a wider slowdown for the sector. So I'm delighted to be joined exclusively by Patrice Louvet. He's the chief executive of Ralph Lauren. Patrice Louvet, thank you so much for joining us on The Pulse.
Wonderful to be here. Thank you.
On a pretty impressive year. Now, Ralph Lauren has always been intimately tied to sports. You're here also for Wimbledon, which is really a business case in making sports more attractive and having the eyes on the spectators wearing Ralph Lauren.
That's right. So it's very interesting. Actually, Ralph Lauren's been inspired by sports for decades. It's foundational to really our heritage. If you go back to the naming of the company in 1967, Ralph hesitated between polo and baseball. So for us, it's at the heart of who we are. We also want to really weave the brand into the fabric of local culture. Yeah. And sports more and more, as you know, is a key part of that. This is our 19th year with Wimbledon. We have partnership with the U.S. Open, with the U.S. Olympic team, with the Ryder Cup.
Which you kitted out.
Which we kitted out, so cannot wait to be in Paris and to see that during the opening and closing ceremonies over the next few weeks. And listen, we're finding it's very powerful for us to engage with the younger generation of consumers, really showcase the brand and the brand stories that we have, and bring just a different level of energy to the brand. And we have, I think, a unique approach to sports, which is we don't just look at what happens on the pitch or on the court. We also turn the camera to what happens in the stands and how people are dressed and their styles.
So, Patrice, does that translate into sales? And again, we've seen, similar moves. LVMH, for example, is very involved in the Olympics. I think the medals will be also put on trays. So you were one of the first to be close to sports. Do you see like others are now trying to play catch up?
So it has a very meaningful impact in terms of brand equity. So I have very clear numbers, for example, as people who are aware of our Wimbledon partnership have a higher perception of the brand, of our quality, of our luxury positioning than people who are not aware, which is obviously an encouragement for us to continue to do more of this. Listen, it's exciting to see other players come into the space, right? And I love the fact that Ralph was a leader in the space and that others are now following our lead.
So where do you see everything going? You've tried to elevate the brand.
Yes.
How difficult is that? I mean, some of your rivals are actually, struggling because of price rises. Is there a healthy appetite for luxury consumption?
From what we see, our core consumer is very resilient, and that's true in Delhi, that's true in Tokyo, that's true in New York, that's true in Miami. What's really playing out for us is the brand is really resonating with consumers right now, and both, the boomers and the younger generation, the Gen Zs. We have a multiple growth driver strategy, which means we're not reliant on one market, one consumer group, or one channel. And you attach operational discipline to that, and you see the results that the company's been delivering consistently over the past few quarters.
What do you see strongest? The U.S. consumer? I mean, there's elections. I don't know whether that impacts actually consumer demand or whether that high-end luxury is untouchable.
So what's been interesting over the past few years is this VUCA world that we live in, right? I think is our new normal. And I think the company's been able to demonstrate its ability to navigate a volatile environment, whether that's in the U.S. Obviously, we have European election results here in Europe. We've had elections in the East as well. And I think as we stay focused on continuing to elevate the brand, engage with that younger consumer where he or she wants to be engaged, leveraging the breadth of our lifestyle portfolio, right? We're not tied to one product category, but this company is about living. Ralph and I always talk about the fact that, we talked this last time we were together, we're in the dreams business and we're about living. And I think as we do that effectively, bringing to life our story, our messaging, our quality to consumers, we are seeing that our core consumer continues to want to engage. And while the headlines on the luxury space can indeed be concerning, we are not experiencing that in the way our business is developing.
And so why do you think that is? Again, there's a number of other players that are trying to get into the home business.
Yeah, I think the core values that have been with us from the very beginning, think authenticity, timelessness, quality, those resonate everywhere. And during times of volatility, what we know is consumers will gravitate towards brand and products they know, brands that provide quality, brands that they know they can wear today, and products they can wear today, but also in 10 years. And I think this element of consistency, there's a lot of discussion around quiet luxury, right? And that really fits nicely what Ralph Lauren is about. We're about timelessness. We're not about the latest trend. We've got a very clear purpose, a very clear set of values, and our job now is to just continue to execute with excellence at every touch point.
Will the logos become smaller, or is it you have the Ralph Lauren collection and then the polo? I mean, again, this quiet luxury, it takes a couple of years, I guess, to catch up.
Yes, it's been interesting to see the evolution of the size of logos over the years, right? And actually, when I started in this job, my son said to me, well, as long as you have large logos, I will not engage with your brand. So that resonated with Ralph and I. It's less about the logos. It's really more about your core values and what we really stand for. And authenticity has been a key to Ralph's success ever since he started this company. And we look at everything through this lens of, are we authentic? So the partnership with Wimbledon that we talked about earlier, is very authentic to who we are based on the Wimbledon values, our purpose, and we're being very choiceful in everything we engage in. Make sure we're showing up authentically.
Patrice, how's China doing? I mean, China. We talk, almost day in, day out here about the fact that the economy is not doing as well as expected. Is this still one of the kind of the core markets that you need to get right?
So I'm happy to report China is doing very well for us, and I continue to be very bullish on the mid and long-term opportunities for China. A couple numbers: last fiscal year, which we just closed, we were up 30%. Off of plus 23% the prior year. Last quarter, we were up double digits. China today is about 7% of the company. Used to be around 3% before COVID, so we've got nice momentum. But when you look at our luxury peers, the penetration of the China business is much higher than that. So I think we have significant runway. Our consumer continues to respond really nicely. We are able to recruit new consumers, both men's and women's. Our product lineup is resonating. And I think this is the combination of global assets and propositions and values that connect with the Chinese consumer, and also really good local execution. We have a partnership with Mr. Bags, for example, who's a local celebrity on handbags. That's actually really been playing out very well for us. We only focus on top 6 cities so far, so there are more than 6 cities in China. Significant runway for us.
So is that your biggest, I guess, if I ask you your biggest challenge for the next 12 months, are there any acquisitions on the table that you'd be looking at, or is it expansion in certain countries?
So our strategy is really reliant on multiple drivers of growth, on the brand side, on the product side, on the geographical side, and channel side. We have significant growth opportunities across all of these. So M&A is not a priority. We stay open to what may come along, but we believe that we've got significant growth opportunities for many years to come within our current strategy.
I mean, 2 of the most famous department stores in the U.S., I think, merged very recently.
That's right.
Does that make a difference to how you see the U.S. retail space?
So U.S. wholesale has been challenged, right? And actually wholesale even here in the U.K. has also been challenged. I think for us, as we look at this merger, I mean, they've both been historical partners for the company for many, many years. We have very good relationships with both of them. Stronger partners, healthy partners, they are a good thing for us. So I'm hopeful that coming out of this merger, we'll be dealing with Saks Global, which will be an even stronger entity, and that'll help us further develop our business together.
How mindful are you about price increases? Again, we've seen some of your rivals maybe increase prices by too much, and there's been a bit of a backlash. I mean, what's the right way to calibrate it?
We're very mindful. The filter for us is value perception, right? So actually, if you take our average unit retail over the past 5 years on our elevation strategy, our average unit retail is up close to 80%. And yet our value perception and luxury perception is the highest it's ever been. And we track this every month in all of our key markets. I think as long as we do a good job elevating the product, elevating the storytelling, elevating the consumer experience shopping online or in store, we will be able to continue to increase average unit retail. Our pricing obviously has been a bit higher, like-for-like pricing, a bit higher over the past 18 months because of the input cost increase, particularly the significant increases on cotton. Now, as that is abating, we will not be as reliant on pricing moving forward. But we continue to have product mix, channel mix, geographic mix that contributes to the growth of our average unit retail.
I don't know whether to put you on the spot and ask you who's going to win Wimbledon.
Well, we talked earlier. I'm a huge Alcaraz fan, but ultimately what I hope for is just incredible matches, both on the women's side and on the men's side, so that they continue to see ratings grow up and significant visibility for the tournament, not just here in Europe, but actually around the world. We know this property is resonating everywhere now.
Wimbledon is pretty special. Is there another thing like Wimbledon that you'd like to be involved with?
We really like the partnership with the Olympic team, because our purpose is to inspire the dream of a better life through authenticity and timeless style. And I can't think of a better connection than this young kid who aspires to be an Olympian and the journey that they have to go through. So we've been partners with the Olympics now. This is our 9th Olympic. It started in 2008. And I think that really captures the essence of what Ralph Lauren stands for. And we're very excited about that. But, you know, we sponsor the U.S. Ryder Cup team, the Australian Open, the
So
US
we're not going to have a
Open.
new partnership on anything that we haven't heard about yet.
Absolutely. And you and I talked last time we were together gaming, right? We sponsor the T1 team, the G2 team in gaming. So we want to be where our consumer engages, where their passion is, and what's authentic to us.
Patrice, thank you so much for joining us today. That was Patrice Louvet, the Chief Executive Officer of Ralph Lauren. Coming up, we talk banking. Archegos founder Bill Huang found guilty of fraud and market manipulation 3 years after the fund's collapse. We'll have plenty more details on that next. And this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
20 countries. The moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Welcome back, everyone. Now, France's President Emmanuel Macron has called on parties that represent Republican forces to build a broad majority from the political center. Now, the snap elections left the country with a divided parliament and no obvious path towards a stable government. Now, Macron wrote in a letter he would wait to name a prime minister in order to give negotiations between parties a chance to bear fruit. The Archegos founder, Bill Hwang, has been found guilty of fraud and market manipulation stemming from his firm's multi-billion-dollar collapse in 2021. Now, the jury delivered verdicts against Hwang and his co-defendant, former Archegos chief financial officer Patrick Halligan, in a Manhattan federal court. Both men will be sentenced on October 28th. And Novo Nordisk's once-weekly insulin has failed to get approval from U.S. regulators after the government asked for more information to complete its review. Well, Novo said the agency asked for details on the manufacturing process and the type 1 diabetes indication. Well, the Danish pharma giant says it's evaluating their requests and plans to work closely with the agency. And Apple aims to ship at least 90 million iPhone 16 devices in the second half of the year, counting on AI services to fuel demand after a bumpy 2023. Well, Bloomberg understands that the company told suppliers and partners that it's targeting about 10% growth in shipments of new iPhones compared with their predecessors. The U.S. tech giant has grown confident that the addition of some Apple Intelligence features with the iPhone 16 will help boost demand when the model goes on sale later this year. Coming up, the UK Prime Minister Keir Starmer sets out about repairing Britain's reputation on the world stage. But he'll be back from the NATO summit, so we take a look at new Labour government's first week in office. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacroix here in London. Now, UK regulators are set to overhaul their rules for companies looking to make their public debut in London. Now, it's part of the FCA's effort to draw more IPOs to the city, and comes after scrutiny of wider UK equities in general. Now, the UK, with Spain, has been named investors' most favorite European equity market in Bank of America's June Fund Manager Survey. So let's head now to Bank of America's Breakthrough Technology Dialogue, bringing together more than 50 of the world's top CEOs, innovators, and other key players involved in new technologies. Well, Daybreak's Tom McKenzie is standing by with a special guest. Hi, Tom.
Francine, good morning. Thank you very much indeed. Yes, very pleased to say, joined now by Haim Israel, the head of thematic research at Bank of America, with that forward view on some of the themes, some of the evolutions that investors should be thinking about, particularly when it comes to technology, generative AI. But I want to start with that question, the changes coming through from the FCA, the regulators in the UK, to streamline the listing process, no doubt with an eye on tech companies, and no doubt thinking back to ARM deciding not to list in the UK. And I just wonder, given your prism on the world of tech, how important these changes are if we are to encourage companies to come and access the public markets in the UK.
Well, the market is changing, Tom. The market is changing very fast, and I think part of the new regulation that we see is part of it. You know, if we had this conversation back in 1960, the average life expectancy on a company on the S&P 500 was 62 years. It's down to 12 years. Companies are vaporizing left and right, and I already saw some research talking about 9 years and 8 years by next year, because the regulation is not changing fast enough. We're in part of one of the biggest revolutions ever from a technological point of view. We have to encourage capital flows. We have to encourage innovation. The capital market will be a center part of all of this. So regulation have to adjust very fast. And if the UK wants to be part of this whole revolution, I think this is probably a step in the right direction.
All right, fascinating. The life cycle of companies going from about 60 years to what, about 12? Talk to us about the next break. I know you think about this very deeply. It's the topic, of course, here at this event, generative AI, the impact it's going to have. And you're not just thinking here and now, you're projecting out years ahead and giving us a sense of how this evolves and how this develops. What are the next breakthroughs you're looking at?
We're part of one of the biggest revolutions we've seen. I'm a big believer in that. We are, first of all, in the short term, we're heading into an investment cycle. We're going to invest more. We're going to see probably more and more cash allocated to that. We're not going to see the returns in day one. But what's going to happen going in forward? Productivity is going to go up dramatically. We're going to start seeing AI across everything, what we call AI for all, in every device that we carry, from our mobile phones to our smart assistants to our cars, everything around that. But the big revolution that I'm a big believer is about to change everything is what we call simulation. Harnessing generative AI to start simulating big data sets like molecules, like chemicals, stuff that is taking us billions of dollars, taking us a lot of time with very low success rate, and about to change everything. Think about drug development. Think about chemicals for our industry, for everything around that. Think about batteries. Today, battery composition and chemistry around is one of the most complicated things out there. Things about industrial or logistics or everything around that, that today it's all been done with trial error, with very, very low productivity. We can start doing that on simulation using generative AI, and we believe that's probably the killer application.
So how should investors be thinking about taking advantage of that then? Do they invest in the enterprise, in the sector, or do they invest in the companies, the AI companies, building some of those components, building some of those services?
We're going to look about across everything, from the hardware that's needed for the companies that are actually going to generate that across the supply lines. But the way that I would start thinking about it, I'm a big believer that in the coming years we'll have two kinds of companies, no matter which industry we're looking at. Companies that are using generative AI and companies that are just going to be so far behind. I think that the way for investors going forward is start asking questions. Every CEO, every management team, about how serious, what are you actually doing around harnessing generative AI? Because one of the mistakes that we keep seeing in the market, thinking that AI is a tech product for the tech industry. No. We're starting to see investment in healthcare, financial services, industrial, consumers, real estate. Every industry out there can start generating more and more value with generative AI, and it's going to be up to us, up to investors to start asking the questions.
What does it mean for jobs?
Well, the job market is definitely about to change, but not necessarily in a bad way. I'm a big believer that every time we've seen innovation, eventually more jobs have been created. Think about the ATMs back in the 80s for the financial industry. Everybody thought that would be the bank killer. Guess what happened? The number of jobs have shot up. This time around, two things are about to change. The revolution is happening so fast that we might see the job going down before we'll see more and more productivity gains, and then jobs will definitely go up. The second thing that will happen is that some jobs that we've done in the past could be eliminated. We will need different skills. We'll need to ask ourselves, what are we doing that can be automated, what cannot be automated? And new jobs on the back of it will come out. We'll have to ask ourselves, what skills do we need going forward to do a job in the future?
Okay, you are clearly convinced of the revolutionary impact of generative AI. The skeptics would say that companies are sinking a huge amount of cost into things like GPUs, the chips, and the data centers for very little monetization, very little profit, very little commercialization. There's a gap there. Should that concern people?
We could ask ourselves the exact same question, Tom. Every revolution out there, how much money we suck into the internet? The dot-com bubble, or back in the 90s, the data centers.
There were casualties.
There have been casualties, but that's an evolution. When we've seen every time there's a lot of money spent, some comes out, but you think about from the dot-com bubble that billions, if not even more than billions, were invested in all the data center infrastructure, telecom equipment, and everything around that. Many companies have disappeared on the way. But Google were born, and Amazon, and Netflix, and Apple, and all the companies were born, and Microsoft were born then. We are about to see the same revolution again. And when we think about what could be seen in other sectors and productivity gains and innovation that is accelerating dramatically, already, we are only 18 months into the revolution. The amount of money that we are investing right now is actually not as big as we've done in the past. And another interesting fact that's actually going to accelerate that dramatically. Every revolution that I've mentioned in the past, the railroad, the electricity, the industrial revolution, we didn't have the infrastructure. This time we do. We have the infrastructure. The revolution is going to happen so much faster.
Do we have the energy, though? Do we have enough energy to power this revolution?
Great question. No. We are about to move from what we call the energy transition. On top of that, the energy addition cycle. I think that we're going to be very surprised very soon about how much energy we'll need. I think the projections around the world are probably will have to be changed about how much energy the world is consuming. The IT sector is becoming one of the biggest energy consumers out there. The data centers, not just energy, by the way, it's water, the cooling systems, everything around that. And it's going to be a challenge. How do we bridge this gap? Do we bridge it with fossil? I think not. Do we bridge it with renewable energies? I think yes, because of the scalability, because of the cost, because of a lot of other factors as well. But we're definitely going to need more and more resources.
Okay, Chaim Israel, thank you very much indeed. Absolutely fascinating in terms of how generative AI can reshape our economy, our world, and companies. Of course, the head of thematic investing and research, I should say, the head of thematic research at Bank of America, and of course, senior strategist at the bank as well on that view. Projecting forward in terms of the impacts of generative AI. Francine.
Yeah, so good. Thank you so much, Tom, for bringing us that interview with Chaim Israel. Now, we'll have plenty more, of course, throughout the day. Also, less than a week since becoming UK's new Prime Minister, Sir Keir Starmer is attempting to repair Britain's reputation on the world stage, while Starmer attending NATO's 75th anniversary summit, meeting with key allies. And joining us to discuss all of the details is Bloomberg's Joe Mays. Joe, thank you so much for joining us. Look, it's been 7 days. I mean, it's incredible to think that 7 days ago the UK was voting, and since we've had a new cabinet, they've met, we have new policy from Rachel Reeves. What do you think has been the most decisive moment for Labour in the last 7 days?
I think it would have to be Rachel Reeves's first big speech at the Treasury. I think there we saw a real shift in British politics writ large. We saw a government come in which is effectively fully committed to economic growth, such that they are going to make big changes in the planning system. They're basically given carte blanche to Ed Miliband and Angela Rayner to push through house building, to push through more energy infrastructure. That is a significant moment that, I think will have ramifications for a long time to come. And as you mentioned, Keir Starmer also having his big introduction on the world stage at this NATO summit in Washington, meeting President Biden, meeting President Zelensky. Politics moves fast, and this has been a very fast week.
So, Joe, what did we learn actually from Rachel Reeves? I know there was, I guess, two things. We're still waiting for a lot more detail on the workplace, on, how some of the worker rights will be affected. We still have to wait a lot of stuff on taxation. But she talked about this new sovereign wealth fund. What does it look like?
Yeah, so she talked about this national wealth fund, which we had a report come out from Mark Carney, who's been leading a task force, which is advising on how it could be structured. Now, the aim is to crowd in lots of private investment at a time when the state doesn't have much money to spend on boosting economic growth, crowd in that private investment. And that report was looking at different options and different funding options that investors could be attracted by. Still more details to come on that, but that's all now in train. Richard Reeves has said there'll be an international investment summit within the next 100 days, again, as part of an effort to bring in that private capital. So that's one big part of the picture. And then as we talking about on the planning side, she was saying that they're bringing back mandatory national house building targets. There's going to be a real push to unblock construction, make things happen that weren't happening before. So it's a two-pronged approach, really. It's private investment plus big planning reform.
Joe, is it very important for international investors that they get the planning right just to make sure that they mean business? Or how long will the honeymoon last? I know there's also, you joined us for a great podcast on this, which I think is out today. So thank you to Summer for putting it together. But is it 100 days or does it last less, this honeymoon period?
Well, I think my sense is that the honeymoon period will probably last until the first budget, which is going to come in the autumn. We don't have a specific date yet, but that'll be when Rachel Reeves will have to make some pretty tough decisions on tax and spend. Bloomberg reporting this morning that she could face a fiscal hole of up to £30 billion if the OBR reduces growth forecasts. And that would mean that she'd have to find some tax increases to fill that hole, or spending cuts. Spending cuts would be pretty undesirable for a Labour government that's just newly in power. And when it comes to tax hikes, well, the Labour manifesto really did restrict what they could do. They can't increase income tax, national insurance, VAT, all these big levers you might want to pull. So she's perhaps going to look at kind of salami slicing other more minor taxes to raise some money. So that will be a tricky moment. But you're right, on the planning side, just one more thought here is that investors want to know that if they commit money to projects, those projects will actually happen. And that's why they've not been able to have that confidence in recent years, because of things like the effects of Brexit, the uncertainty that caused, because of the Conservative government's reticence to really back construction in the face of kind of NIMBY pressure. We know the Labour Party, at least on the evidence of Rachel Reeves, they're not going to be swayed by that kind of opposition. So that's why I think it's kind of a green light in the eyes of investors that construction projects will now happen in the UK that didn't happen before.
Joe, what have we heard from Keir Starmer at NATO? Again, he comes in; it's his first major international outing. He has a good majority. He's in charge for 5 years. It feels very different to some of the question marks over the other leaders.
Yeah, I think two big things we've seen. One is that he's really looking to build a closer relationship with Europe. He's working on securing a defence and security pact with Europe quickly. We have that European political community meeting happening next week. He's taken with him a large entourage of ministers, including Nick Thomas-Symonds, who is installed in the Cabinet Office as his minister effectively in charge of European relations. That's a real sign of intent, I think. He's meeting Chancellor Scholz as well. And President Biden was welcoming this change in tone from the UK and essentially saying that the UK is the knot that holds NATO together, and how he supports that closer relationship with Europe. He thinks that will strengthen the kind of alliance of Western liberal democracies. So that was the big move on Europe. And then also we had him saying that he was committed to allowing Ukraine to continue using those Storm Shadow missiles in the way that they wanted, effectively giving them permission to strike in Russia. That's an important permission that President Zelensky has welcomed. So yeah, kind of a clear commitment on Ukraine, plus that move towards a closer relationship with Europe, which is quite significant.
Joe, thank you so much. Joe Mays there with the very latest, of course, on the first week in power of the new Labour government. Now, be sure to subscribe to Bloomberg's In the City podcast that I host with Allegra Stratton and Dave Merritt as we uncover the best stories and speak to the people in the know. And this week's episode, we were joined by Joe Mays. Coming up, the UK economy expanded at twice the expected pace in May. We discuss what it means for the new government's ambitious plans. Next, this is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate Just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back, everyone. Now, the UK economy expanded at twice the expected pace in May. Now, the new Labour government will be counting on signs of strength like this to fund its plan to get the nation working again. Let's bring in Dan Hansen from Bloomberg Economics for more on this. Dan, I mean, getting the nation working again is what they use as a catchphrase. I mean, these seem actually like, you know, really good figures for them. Of course, it's not up to them because it was the previous government. But how will Rachel Reeves be looking at this?
She'll be over the moon with that, I imagine. The economy has performed far, far better than anyone expected at the start of the year. As you say, it's nothing to do with Labour, but if you look at, for example, the consensus versus what we've seen in the data, we've been getting beats on monthly GDP since the start of the year. I think the big question here is how much of this is sort of catch up from, because we've had 2 years of no growth. How much of this is catch up? How much of it is sort of a story about the medium term? You know, how much of this is going to be banked into the future? Our sort of view is that it's the first of those two things, that it's sort of a cyclical phenomenon. Sort of the economy can operate at full capacity up here and it's sort of catching up to that level. But to answer your question, Rachel Reeves, if I was looking at those numbers and I was Rachel Reeves, I'd be over the moon.
Yeah, you're kind of, you know, lucky given everything that's happening. What does it mean for the Bank of England? Because so there was almost a, you know, it was priced in that there would be a cut in August, and then we heard from Catherine Mann, who's frankly the ultra hawk in this, and so there's been repricing. Do you think we get something in August?
It's really tough now. I mean, this data obviously creates a question around it. I think the comments yesterday from Catherine Mann, but more specifically Hugh Pill, he just doesn't seem there with an August cut. And I think, I mean, now it's below 50% pricing for August. I think at the moment it feels to me like a coin toss. We're on the side of them going for it. But I think when you step back, one thing that you have to potentially believe if they are going to go for a cut in August is that you're going to get this big divide with the internals. So you'd have Governor Andrew Bailey, Claire Lombardelli, who's the new Deputy Governor for Monetary Policy, and potentially Sarah Breeden. If Hugh Pill doesn't go for it, you get a 5-4 in favour of a cut. That's a bit of a strange message to send, particularly when it's the first one of the easing cycle. For me, it is a 50-50 decision, and we've got CPI next week. That could sort of make or break it, I think.
But is it important for the market to understand, even if we do get a cut in August, that it could be actually one and done? Or just one of two? Because, again, in the past, and we've spoken about this before, that the cycle was always start cutting, and then you're in a cutting cycle, whereas this is different.
Yeah, it is. I mean, this feels... Normally, when you see cutting cycles in history, at least, it's because the Bank of England or a central bank is responding to a recession. This time, it's a normalisation. So the right thing to do is go a little bit more slowly, particularly with the data we've had, GDP data, services inflation data. So I think one thing I found interesting about the comments yesterday, Hugh Pill said it's when, not if. So it's sort of, you could go in August, but I think if they did that, you might be waiting a while for the next one. We think that there's a chance there's another one by the end of the year, so 2 over the year in total. but it feels to me that they're going to be very, very cautious about how quickly they move down, because there's so much uncertainty about where the neutral rate is, the rate that neither speeds up nor slows down the economy.
Yeah, the neutral rate that no one wants to talk about. Dan, when you look at actually what we heard from Rachel Reeves, I mean, are they doing the right things, this new government, to get to that pretty ambitious growth target?
Yeah, I mean, the 2.5% growth target is hugely ambitious. The things they've announced are the right things, but we've had a lot of governments that have tried to deal with the planning system and have failed. The amount of investment they've announced, again, it's exactly the right thing to be doing, but the fiscal constraints in the UK are significant. So the amount they can genuinely offer up on the public sector side isn't huge. So there's this big reliance on what they call crowding in, where the private sector makes up the shortfall. So I think our view is, at least, that the policies are right.
Yep.
It's extremely challenging, and certainly the 2.5% growth target, based on what we've seen, probably won't be achieved. I think that's not a big bet to make. But there are some upside risks, I'd say, to our forecast. We think trend growth in the UK is about 1.2, 1.3%. What they're announcing does create some upside risk to that, but it's about delivery now. They've made a lot of announcements. It's about making it work.
Dan, thank you so much. Dan Hansen there from Bloomberg Economics. Now, coming up, the UK's biggest water and sewage company could be broken up or forced to cap its debt. More details on the regulator's proposals to rescue Thames Water. That's next, and this is Bloomberg.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back, everyone. Now, Thames Water could be broken up, listed on the stock exchange, or forced to cap its debt under special measures plans set out by the regulator Ofwat. Now, the UK's biggest water and sewage company is to be placed under a turnaround oversight regime to help lift the firm out of crisis. Now, for more on all of this, we're joined by Bloomberg's Rachel Morrison, who's been covering the story from the very beginning. I mean, Rachel, when you think about it, I mean, this is a huge company, right? And, of course, there's been this, scandal around it. What are these special measures?
Well, today, Thames is the only company that's been put under this special regime. And if you sort of think about it as Ofwat saying, we've seen what you've been trying to do, we don't think you're going to achieve it, so we are going to come in and help you try to do this. So they will potentially put someone from Ofwat inside Thames with full access to the company records and everything to report back to Ofwat on what's happening. And as you set out, those are the scenarios they see that could need to happen to get Thames back to where it needs to be able to invest in the water infrastructure to fix leaks and stop sewage spills.
So is this good or bad for Thames Water?
In a way, it's good because it sort of says Ofwat is on board with you, and it's kind of backing of the regulator to say we aren't going to just let you fall into a sort of state where you need temporary nationalisation. So it could be seen as positive, but we don't know if it's going to be enough for investors to say, yes, we are now willing to give you equity, which has been the big question for Thames.
So what if the special measures don't work?
At that point, Thames has enough money to run the company through until May. So if no new equity is found and the special measures are unsuccessful, then at that point, it will look as though the government needs to step in with that special administration, which is what we call temporary nationalisation.
Have we heard Labour on this yet?
The water companies are going in to meet with the Environment Minister this afternoon, and there'll be a statement after that.
Okay, so watch this space. Thank you, as always, for joining us. Rachel Morrison there on the very latest with Thames Water. Now, another reminder to subscribe to our podcast in the city. It's out today, and of course it focuses on the first week in government by the new Labour Party. Coming up, it's Danielle Manis, Bloomberg Brief, and this is Bloomberg.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, a million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Good morning from London. I'm Menace Craney with Danny Berger in New York. You're welcome to Bloomberg Brief. Let's set that agenda.
Countdown to CPI. Forecasters expect the smallest back-to-back increase since last summer, adding to the case for a September rate cut. Pressure mounts on Biden. More notable names come out for the president to step aside, including Vermont Senator Peter Welch and Hollywood actor George Clooney. And after Lucid delivery numbers calm fears over EV demand, we speak with CEO Peter Rollins on the company's future. Good morning, Manus. Happy CPI Day.
Happy CPI Day, Danny. You know, football's coming home for the UK. Can the CPI, yeah, absolutely. Can the CPI bring it home for the stocks? There was a furious amount of buying in the S&P 500 last night into the close, spiking up on NVIDIA, spiking up on tech. Get ahead of the CPI, because if that CPI comes in any way in line, it could invoke the wrath for the bulls. Up for a 7th day in a row. We give it a little bit back this morning. 10-year bonds this morning trading at 4.28. Again, the 10s went very well yesterday. Powell saying good ways to go. Again, just holding back. 10-year paper in the auction flew off the shelves. If the CPI is really, really good, the JP Morgan survey of longs will be rewarded to Brent. I thought we'd just pop that in there, Danny. What we're seeing is the IEA's narrative come out. Global oil demand growth slow, so we've come back. That's still in the green, up by 0.2%, but that post-COVID rebound has run its course. And the question is not just in oil, but in the consumer, in the savings, and in the narrative out there. Are we at the end and the beginning of a much more significant disinflation narrative? Danny, good morning from London.
You're really tempting me by saying it's coming home, because, you know, the only thing I want to chat about this morning is football, but, you know, we have more important things to talk about maybe. It was a snoozer for this market, right? It didn't move much, but I thought Nick Timrose at the Wall Street Journal put it really well, that we're witnessing the pivot of Powell from concentrating on inflation to giving a much more sturdy base for cutting, and that is the labor market. He said the number one thing keeping it up at night is getting inflation back to 2%, but doing so in a way that makes sure the labor market doesn't crack.
Yeah, delivering the soft, double soft landing, so to speak, and that dual mandate is all the more important. I know that we both read Paul Donovan's notes quite seriously. He's talking about today the owner equivalent rent, excluding the fantasy owner's equivalent rent, is going to give us a much better idea of where we are, where the middle class are, Danny, and that's critically important.
Yeah, he said that to us before when he's been on with us, the fantasy of OER.
Yeah.
I was actually looking, an economist over at the BLS basically said last month's OER was weird because of strange statistics from New York and kind of how they surveyed people, and that's a problem, right? If this data is not exactly reliable and strange things and ghosts are tampering with the data that we see before our eyes.
Yeah, and we've had a lot of debate about the data and about New York rents, furious scrabbling around for apartments. Anyway, it seems to be a global issue. Let's talk about that testimony from Chair Powell. It was day 2. It was in front of Congress saying that he believes inflation is receding, but we're not there yet.
We want to be more confident that inflation is moving on a path sustainably down to 2%, not at 2%, but on a path sustainably to 2%. That's the test we've articulated. I have some confidence, as I said earlier, that we are on a downward path. I think if you look at the data, it's pretty clear that, but we have not said, though, that we have sufficient confidence, and that will be a decision that our committee makes.
Our guest this morning is Olivia Micklem, Portfolio Manager at Artemis, and she writes this. We are seeing ongoing evidence of deflation creeping into the system for the consumer as well. McDonald's launching value menu items, or Walmart increasing their rollback count by 45% last year. Olivia joins us now around the desk. So you see this disinflation narrative. The question that Danny and I would have is the breadth and the depth, and the question we ask everybody, acceleration.
Good morning. So, yeah, I think what we're seeing is there have been pockets where the low-income consumer has looked a bit pressured, and in response, we're seeing the likes of Walmart and McDonald's start to offer some more value back to them. That's really leading to some of this disinflation narrative that we're starting to see in the system. More broadly, to your point on rents, if you look at private market data, we're seeing that data start to improve and come down as well. So the overall trend, I think, remains supportive for what we and Powell are looking for in terms of that inflation dating starting to correct.
In terms of how this market reacts, Olivia, and specifically this equity market, I could probably craft a narrative either way to say hot CPI, cool, the economy is great, I should be buying tech. Maybe cooler CPI, I could say, cool, the Fed's going to cut, I should be buying tech. It's confusing how this market will react to the data that comes in. So what for you do you need to see that it still keeps intact the bull case for this equity market?
So I think from our point of view, what we're really looking for is to be the stock pickers. So while the overall market will react how it reacts, what we're looking for is the individual companies, how they're performing, how their profit margins are looking. And as we are heading into Q2 earnings season, that's a really important factor for us to watch. But I agree, I think there seems to be both sides of the coin could continue to be supportive for markets at this point.
We'll dig a little bit more into this, but we have one breaking news headline from Apple, of course. Yesterday evening, they were saying to us that they were going to sell 10% more phones, but they have settled an EU antitrust probe over tap and pay on tech. So we'll dig into that a little bit more, but breaking news from Apple. Look, when we talk about trying to diversify the portfolio, lots of people have been very cautious about, when do I go for, value stocks? We're looking at growth outperforming value by the most since 1995. Now, that is not a shocking fact. What is a little bit more important is that onward trajectory of growth relative to value is when does value shape up in the narrative? Either the profit drop that we've seen in value has got to change, or we've got to see something on the earnings flow in tech that shifts us to diversify. How do you look at that conundrum?
I think we try and look, as I said, on an individual stock-by-stock basis. And I think if you look beyond the mega-cap tech trends that we're seeing, there's an awful lot of opportunities in the market, both in large cap, but particularly in small cap, that are really attractively valued. So we would say that small cap is providing some really interesting opportunities, great discount to large cap at this point. And there are both growth and value companies in there that are good enough quality, trading at really attractive valuations. And we think those opportunities are being overlooked.
Olivia, I think you and maybe Julian Emanuel at Evercore are the only people who have talked to us and said that they like small caps. It's such an underloved sector right now. But just put that into what you were saying before. Is this, I can buy some of the small caps in there, or can I go out and buy the Russell 2000?
I think it's all about being selective. There's an awful lot of businesses in the Russell that are still unprofitable. They're perhaps very early stage growth, or those that have been struggling that are perhaps on their way towards, a more tricky situation in terms of bankruptcy. So you've got to be selective where we think active management is really important. But we certainly think that that is the place to be looking for the best opportunities at this point.
Look, we're debating on a daily basis. Danny and I are going to spend the next part of this show talking about whether Biden continues on the ticket. What does it mean for the White House? Your job is to step back from the day-to-day minutiae and the noise that people like Danny and I create, and to tell us what is the future for bigger long-term equity returns on dividend yield and cash flow. Beyond tech, you say that is infrastructure, regardless of who sits in the White House next year?
Yes, we really think so. So obviously we've seen the infrastructure bills from Biden have been very, very popular. The US has had massive underinvestment in infrastructure for a long time. So these bills are very popular. Money has been dispersed, and it's benefiting both traditionally Republican and Democrat states. So we think that irrespective of who ends up in the White House at the end of the year, I think there is bipartisan support for perhaps an extension to the current bills and ongoing investment, which would benefit anything exposed to infrastructure in terms of the industrial complex from here on in.
The bond market, though, Olivia, has been worried about growing deficits and maybe more inflation under Donald Trump. Does that translate to this equity market? Do you think about that, or do you stick with your infrastructure plays?
So I think, yes, there are components of perhaps what we might see under Trump in terms of tariffs that would be inflationary. I think generally speaking, it's fair to assume that we are existing in a higher for longer market than we were before the pandemic. So I think in whichever scenario we're looking at, it's fair to assume that inflation will stay a little bit higher than it's been in the past and rates might stay a little bit higher, but should come down for where they are now.
Okay, Olivia, really wonderful to speak with you this morning. Thanks for joining us in the studio there in London. Olivia Micklem of Artemis. Just want to touch on those breaking lines that Manus mentioned about Apple. They are now avoiding an EU antitrust threat over their tap and pay probe deal. It essentially means that third-party apps can come on and have a payment system that you can tap and go. It's not just existing in the Apple universe. Margarita Vestager saying that Apple has committed to allow rivals to access tap and go tech, and it will prevent Apple from excluding other mobile wallets on the iPhone's ecosystem. Okay, Manus, let's get some of the other top stories that are trending on the terminal this morning. The IEA, you spotted this one, says global oil demand growth has slowed to its weakest in more than a year as China's post-pandemic recovery fades. Global demand remains on track to grow by less than 1 million barrels a day for 24 and 2025, according to the agency.
Market tracker IDC says Apple's Vision Pro won't cross 500,000 sales in the year. The company's $3,500 mixed reality headset has yet to sell 100,000 units in the quarter since its launch in the US in February. And domestic sales are expected to drop 75% in the current quarter.
The time has come to talk about football, Manus. Again, the only thing I care about, England v. Netherlands in the Euros yesterday. Ollie Watkins comes in, only touches the ball 4 times, and scores a beautiful score in the right back pocket in the 90th minute, shutting out Netherlands, meaning that football, maybe, I hope, is coming home. They face Spain in the finals on Sunday.
Well, I can tell you what, Anna Edwards has already organized burgers, beers, and a barbecue.
Are you going?
I'll be in Ireland. But look, I think there's a real sense of festival here out in the city. I was in the Ned yesterday afternoon, huge screen. Look, this is a big moment for the UK. The last time they sort of brought it home, it was at Wembley. This is going to be in Spain, Danny. It's going to be a very, very different atmosphere. Looking at the betting odds, in Berlin against Spain. 8-11, Spain are the favorites to win.
Yeah, I was at home watching by myself, and I woke up the whole neighborhood by screaming, and maybe a tear or two.
The Americans won't understand what's happening there, and of course it is going to come down to. I mean, if you look, I was just chatting to some of the people in the newsroom here. There's the 16-year-old Lamine Yamal. I mean, he's already made history. Will there be anybody younger than him?
The youngest ever.
Scoring. Look, the youngest ever. Bit like myself on this show. Coming up in the show, Biden is under pressure. Speaking about age, well, the senators as well as Nancy Pelosi and even his friend George Clooney are now raising questions. Danny.
And Lucid shares, they are hitting cruise control right after beating second quarter estimates. We're going to be speaking with Peter Rollins, Lucid CEO and CTO, later in the hour here on Bloomberg Brief.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's your Bloomberg Brief. Danny Berger in New York. Manus Cranny is in London this week. Now, to politics, Joe Biden's candidacy is facing mounting pressure after Vermont's Peter Welch became the first Democratic senator to call for the president's withdrawal. Axios is also reporting that Senate Majority Leader Chuck Schumer is open to replacing the commander-in-chief. This is all, of course, happening as Biden heads to his final day at the Washington NATO summit. For more, let's bring in Bloomberg's Kevin Whitelaw, who's been tracking it all abroad for us. So, Kevin, we have the list growing. Nancy Pelosi also talking about Biden needing to make a decision. Some of the big Hollywood Democrat donors like George Clooney writing in the New York Times calling for him to step down. This is what he wrote. The Joe Biden I was with 3 weeks ago at the fundraiser was not the Joe Big Effing Deal Biden of 2010. He wasn't even the Joe Biden of 2020. He was the same man we all witnessed at the debate. So what now, Kevin?
I mean, look, this story just obviously is not going away. And one or two strong performances, you know, a good speech here or you know, a good public appearance there just is not going to change the narrative anytime soon for Joe Biden. And the problem he finds is he can have a good day, he could have a good week, he could maybe even have a good month. But all it takes is one or two other high-profile stumbles, and it's going to raise all of these questions again and even further cement the concerns that a growing number of Democrats and independents have about the ability of Joe Biden to finish out a another four-year term.
Kevin, good to see you. Yeah, I mean, look, even though in the break we were sort of saying, well, if it was Taylor Swift that came out and sort of said something, it would actually potentially move the political pendulum. I think the difference is this, is what's being said publicly by the Democrats and what's being said privately. They're trying to wait for this NATO performance, this grand theater piece in Washington, which is a very global moment for him in terms of what NATO does with Ukraine. If you look at Chuck Schumer, according to Axios, he is open to replacing Biden. This is the private conversations, according to Axios. Of course, in public, he's saying something else. How important is that, and how important is it that you've got now a senator, Peter Welch, stepping out into the fray, stepping into the sunlight and making a call for him to go?
Well, at some point, you're sort of getting to a place where the bell can't really be unrung. You know, once you have a couple of really high-profile Democrats out there saying that he needs to step down, and then let's say he doesn't, then it makes it really hard for everyone to go back and say, oh, just kidding, I actually now think he's fine to serve out the term. And so I think that's why you're seeing most of the pressure still in behind closed doors, being quietly leaked out. You saw Pelosi's very careful phrasing, which is essentially saying he needs to make a decision. Most people would have thought by now he'd already made his decision. He's won the primaries. He's won millions of Democratic votes to get to where he's going, and he's supposed to get the nomination next month. There is a very, very small window, and it would be a truly sort of unprecedented, wild event should he decide not to go forward. And so I think that's really going to be ultimately up to him to make that decision. No one can make it for him, given where things stand right now. And in 2020, he thought he was the best and maybe only person who could beat Donald Trump. He appears to think the same thing now, even as a growing number of Democrats have very serious doubts.
Well, in the words of Hollywood, according to George Clooney, the dam has broken, and we can't put our heads in the sand and pray for a miracle in November, or we can speak the truth. This is going to be pretty momentous if there is a step back by Biden, and then we go into the hubris of who replaces him. Succession. Pretty interesting TV show, and it's playing out live in Washington. Okay, good to see you, Kevin Whitelaw there, our Brussels bureau chief on the ongoing political saga. From politics to finance, Archegos founder Bill Huang has, along with his former CFO, were found guilty of fraud in a Manhattan federal court. It took the panel just one day to reach that verdict. Charlie Wells joins us around the desk this morning. I mean, this was a pretty significant finding against Bill Hwang and the CFO. They could face the rest of their life in prison. I mean, what is it, 20 years apiece on each of these charges. So it's a pretty hefty prison sentence. When will we know the worst case scenario?
Look, so sentencing is scheduled for October 28th, but of course this is white collar, and so we see the huge amount of prison time that both of these men could potentially face. But with white collar, you know, there will almost certainly be an appeal. Yesterday, Wang's lawyer did not make any immediate comments about this, but, you know, sentencing in white collar can be served concurrently, and so that can significantly reduce the amount of time that someone has to spend. If you look back to another high-profile white collar case, Sam Bankman-Fried, he faced that maximum potential sentencing of over 100 years. He got 25.
When you look at these sorts of things, these white-collar crimes and quite high-profile ones, you mentioned Sam Bankman-Fried and now Bill Hwang. How does this sort of change Wall Street as a whole? Is there any element of stepping back and saying, okay, we need to look at this more closely. We need to, especially for a bank, look at our risk parameters more closely. I know we had that conversation when this happened, but does the sentencing now change things?
Look, so the U.S. Attorney for the Southern District of New York yesterday, Damian Williams, said that this verdict was a warning for those who want to cheat the system, but a warning is not a change of law. And since 2021, there has not been significant change on the disclosure rules, on the reporting rules that hedge funds have to make, that family offices that operate a little bit like hedge funds, like Archegos, have to make. And so, you know, this was $10 billion down the drain. That was many years ago now. This sentencing is likely to be significant. We'll have to see how that shapes up on the 28th of October. But again, no significant legal changes to how those disclosures have to be made.
Charlie, thank you so much. That is Bloomberg's Charlie Wells on Archegos. Coming up, Manis and I will have your front pages for you.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
get you up to speed with the front pages. News around the world, Danny, this is what we're checking in on. First up, the Washington Post keeps the focus on D.C. and the NATO leaders move to Trump-proof the alliance in Washington. The move is about controlling Ukraine military aid away from U.S. command, signing a decade-long defense pledge and pushing the defense spending.
Next up on the Bloomberg, one of the most read stories is about watches that if you've bought basically any of the luxury watches, Rolex, Patek, all of them are falling even further behind equity. So if you bought them as an investment, you would have been better putting your money just in stocks. Prices slipped again last month. Manus, the only watch that outperformed all of these, or just the watch that performed the best, was Cartier, 2% gain so far this year.
There you go. Tradition holds value. CNN writes this. Costco, the membership fees, they're going up. Now, this is the first time since 2017. What's it going to cost you? $65 up from $60. That's an 8% hike. Takes effect from September the 1st in the US and Canada. And, of course, Danny, Sam's Club, Walmart-owned Sam's Club, they raised their membership prices as well. But you've got a little fast fact of the day on what that price rise is the equivalent of.
I do.
Inform us.
I do, because raising the price by $5 is the equivalent of one rotisserie chicken at Costco. And see, this is the beautiful thing about
rotisserie
Costco.
Chicken.
And why investors love it when they hike their fees, because this is the only way Costco makes money. They're loss leaders on everything else, which is why going to Costco is like Disneyland. It's my favorite activity, Manus.
It's your favorite activity. We're going to hire a car. This is a road trip that we're going to do, and we're going to film it. You're going to take me on a road trip from Midtown New York to a Costco.
Correct.
But we have the producer of the show saying the reason why we're going is because the hot dogs are $1.50 as opposed to going to IKEA for the meatballs.
For some reason, you don't strike me as a man who likes hot dogs, Manus, but they have other good stuff. We'll get a rotisserie chicken and a slice of pizza. It'll be great.
Listen, I'm trying to go for the green card, so I'm sort of, I'm becoming more and more and more, involved.
Yeah, they won't give you one unless you've been to a Costco. I'm sure on that, so we'll make the trip.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less-known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Manus Cranning is in London. Let's set your agenda.
Countdown to CPI. Forecasters expect the smallest back-to-back increase since last summer, adding to the case for a September rate cut. Pressure mounts on Biden. More notable names come out for the president to step aside, including Vermont Senator Peter Welch and the Hollywood actor George Clooney. After lucid delivery numbers calm fears over the EV demand, we sit down with the CEO of that company to talk about the future. Danny, good morning from London. CPI day.
Yes, it is. And it is also another day where I get to stand here in front of this board and tell you about how it's another record in equities, the 37th of this year so far. Yesterday was one with some force. It has been kind of this creep higher to new records. Yesterday was a more than 1% gain. It was helped by the mega cap stocks, but we take a breather from that today. S&P futures down about 0.1%. Not a lot of movement in your 10-year yield either this morning. We are down by less than a basis point, 4.27%. Also sort of a snoozy reaction to Powell. Same goes for your currency market. Euro stronger by about 0.1%, 108.47. But not a lot of reaction to Powell because we've already priced in 2 rate cuts. But we have CPI today, Manus, and then earnings kick off in earnest on Friday with the bank results. So we could see some movement.
Look, I like the way you describe it, you know, a snoozy-doozy kind of Powell testimony. The question is, Danny, you know, are we like overexcited kids in the back of the car that have had too much sugar with the doors closed? And when this CPI comes, it's going to be a bit of a rip-roaring. It's a slow build-up with the sugar, and then when it comes, it's got to be in line or better, I think, to invoke the narrative for the bulls in this market.
Wow, that is the best metaphor I have literally ever heard, Manus. I'm stealing that one. That is so good.
On the fly.
So good. No, but I mean, you make a really good point because, again, we haven't moved much to Powell, but I guess the CPI needs to surprise in a way that's more than 2 cuts because, again, this market is already somewhat ahead of Powell at this point.
Yeah, and again, it goes back to, you know, there's got to be something for everybody. And what was it, the line from Paul Donovan said, you got to exclude the fantasy owner's rent equivalent. We're both living that fantasy and paying that owner's equivalent rent. That's all I'm going to leave you with that thought. But it is an important component, and it is something that has chastened the market on an ongoing basis.
Yes, but it's this push and pull between the market caring about politics, as we did after the debate, and then caring about the economy. Now, on the politics part, Padraig Garvey, head of global debt and rate strategy at ING, writes this: if Biden pulls out, treasuries rally, yields fall, but if Trump wins, treasuries sell off, yields rise, even if eventually, but for unobvious contrarian reasons. And he joins us now. Padraig, great to see you in person. So what are those unobvious contrarian reasons for that?
Yeah, you know, I think it was really interesting after the debate. Clear Trump win, and the markets decided that what does the Trump administration mean? It means growth here and now. It's not so much about the future. It's equity market performance right now. It's tariffs. There's a real inflation aroma to that whole combination. And it's not so much about the deficit. I mean, I kind of disagree with this notion that this is, you know, a worry about the deficit. We've got a big deficit right now. So that combination saw treasuries sell off. And I think if we get the realization of that type of outcome come November, we can have more of that.
Cora, good morning. Good to see you. Yeah, I mean, we were all scrabbling in the dirt for a solid reason on why the steepeners were there, from immigration to tariffs. I like how you're sort of very honest about your moments. You've had bouts of success, but you say if Biden resigns, it is a risk-off event. Risk has been really searching for a reason since November 2023 to fall over. If he steps down, why is that a material risk-off event reverberating?
I think it's, you know, if you think about it, Manus, it shouldn't be, because if Biden resigns, or if Biden pulls out, What we have arguably is more certainty, so it takes that whole story away. But I think risk assets at the moment have had this fantastic run, and they are vulnerable to an excuse to sell off. And I think this is just one of those things that could be an excuse to sell off, because you could construe how that creates all kinds of issues. You know, it has question marks about the current administration. It has question marks about, you know, who steps in place of Biden, how that works, et cetera, et cetera. So, you know, does it impact the economy meaningfully? Does it impact the future in terms of the macro story meaningfully? No, it doesn't. But it just gives risk assets a bit of an excuse to just pull back a bit.
And it's fair. If there's a new candidate, there's a lot of new information we have to absorb and try to understand. Yeah. But if the equity market rally, or risk rally rather, is so vulnerable, is it vulnerable to the data that comes in? Because equities have seemed pretty nonchalant about all of it. Hotter data, soft data, it's still big cap tech wins everything.
It's remarkable. There's such a positive combination of circumstances ahead. We're going to have rate cuts. We're not going to have a big recession. We're not going to have big corporate defaults, credit spreads ultra tight, risk on, rates pretty benign, the whole story, volatility exceptionally low. All of this is a remarkably positive combination. You know, we got the CPI number this morning, expected to be benign. So it's shaping up to be, I think, a set of circumstances that's probably too good to be true. Something's got to go wrong, I feel, between now and September. And I'll have to say, if we go into September with subdued inflation, and let's suppose a mild rise in unemployment, I wonder, will Chair Powell still cut if we're risk on like we are today? If the housing market is as bubbly as it is today? It's a tough one. It's not straightforward.
Yeah, and I mean, well, then you need to go to lunch with Torsten Slok. The two of you can decide that there's going to be, you know, he can bring you over to the no cut side of the table. That is a risk that I think the equity market, and to a certain extent the bond market, has not really absorbed. It still believes it's a far left tail risk. Let's talk about term premium. Lots of people have said to us, oh, look at the term premium. It's turning, you know, it's sloping upwards. Again, with as Danny has said often, the fog of next year, the fog of the back end of this year. Would there be enough term premium yet in the bond market that could potentially compensate me enough for some of the inflation, immigration, and tariff policies that we think may come down the pike if Trump is elected?
Yeah, it's really interesting, because if you look at the 10-year yield today, there is technically no term premium. And what I mean by that is an exposure to the 10-year matches a rolling 1-month bills exposure over the next 10 years based on the market discount. So there's no compensation for the risk you have in the 10-year, which tells me that the market is not discounting the size of the fiscal deficit properly. But going forward, if the Fed goes to 4% and the 10-year goes to 4%, we've got a problem, because we've got no curve, which is why we believe if the Fed goes to 4%, which is 150 basis points of rate cuts, 10s, they got to go to 5. Now, you know, I gotta have a curve. I've got to have a 100 basis point curve. So, you know, unless we have a big recession or something systemically breaks, this balmy combination, in my mind, means that we're looking at 5% as a target going forward once we get beyond this rate cut enthusiasm process.
And obviously in that, as you're kind of talking about, is sort of this deficit finally being priced in and having some term premium for that. Do you think that this is a market that, much like the UK, can have a political influence, that the bond vigilantes can come into any new administration and see their spending and send yields higher and actually have that sort of impact like we saw across the pond?
It's absolutely possible. It just has not happened yet. We've had a few tailed auctions. You know, 10s and 30s have struggled over the past couple of months. But what I'm not seeing is a creeping requirement for a significant new issue premium that pushes up yields and causes yields to price in a positive term premium before the Fed cuts rates. Because the easiest way to generate a term premium is to get rates down. But as it is, it's just not there. It's remarkable. I mean, it's great for the Treasury because they are managing to issue, I think, at very advantageous levels in the 10-year part of the curve.
Porg, obviously that slope on the 10-year premium has been incrementally improving. I take your point that it's not in the green just yet. Talk to us about other things that could push the global flow of money. I'm reading stories on the Bloomberg this morning. The rich are getting ready to leave France. They've been trying to do that for years. The rich are getting ready to leave the UK. Well, they have been doing that for years. But this is about the global flow of money when you take the Bank of Japan into the mix, when you take the global outflow of money from Europe, and I'm not being facetious about it, a flow of money out of Europe, out of France, out of the UK, etc. That money washes up somewhere, and to a certain extent, that flow is dollar.
Yeah, and if you look at the liquidity circumstances here in the US, they are really ample. I mean, on my numbers, we still have a $1 trillion excess liquidity circumstance here in the US, and I'm firmly of the opinion that it's been a really important bolster for the US economy over the past number of months. We have over 400 trillion of idle liquidity going back to the Fed on the reverse repo facility every month. Bank reserves are at 3.2 trillion. They have been falling, but we still have an excess of liquidity. So liquidity has not been an issue for dollars. And yeah, I mean, it's been a really positive story over the past number of months, and it looks like it's going to remain that positive story. I have to say as well, okay, I was kind of surprised that the Fed tapered their quantitative tightening so soon. But I guess that's a whole other story.
And we'll save that for another day when we get a little bit of news on that. The Bloomberg House we're going for a really good core CPI, to use Jay Powell's words themselves. Porg, thank you so much for being with us this morning. That is Porg Garvey of ING. Coming up on the show, we're going live to West Sussex for the Bank of America Breakthrough Technology Dialogue. Peter Rawlinson, the Lucid CEO and CTO, sits down with Bloomberg for an exclusive conversation. Context matters on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers. It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
It's your Bloomberg Brief. Lucid shares are off to a hot start this month. They're up nearly 20% since July 1st. The shares are rallying after the EV startup announced second quarter deliveries and production targets above expectations. Joining us now, I'm pleased to say, live from the Bank of America Breakthrough Technology Dialogue is Lucid CEO and CTO Peter Rollins with Bloomberg's Tom McKenzie. Tom.
Danny, thank you. It's very timely, actually, because the Festival of Speed is happening as we speak as well. So a lot of auto heads, a lot of petrol heads here, but we're not talking about petrol, we're talking about EVs. And as you say, the CEO of Lucid joining me now, which is a fantastic conversation. We hope. Danny, I'm going to bring you that now. Peter Rawlinson, the CEO, of course, of Lucid. Let's start then with the production delivery numbers. As Danny was saying, stronger than the markets expected. The shares have had a lift on the back of this. And we compare that as well. We bring in the Tesla story, because they've come in with slightly better numbers as well in recent days. Is this a sign that the EV market is starting to turn around, Peter?
It certainly is for us. We're up 70% quarter on quarter with a record delivery in Q2 on the back of another record delivery in Q1. Things are looking up. And I think more people are getting the message that we have an extraordinary product in Lucid Air. And everyone's also looking forward to our new SUV, the Gravity, which is coming later this year.
Give us an update on the Gravity, because I know analysts are looking at that as well. And they know that they see that as consequential, really consequential for your story longer term. So the Gravity SUV, is production on track? What is the time frame? What is demand looking like?
It is scheduled for start of production late this year. We're seeing an incredible latent demand because this is an unprecedented product. It has a range of attributes which really have no right to coexist. It has the driving dynamics superior to a Lamborghini Urus. It has the presence and stance of a Range Rover. It has more interior space than an Escalade, and yet it is only a slightly smaller on the outside than our Lucid Air. It's a 7-seat, 3-row SUV. This is what the market has been waiting for.
Okay, that's a very good sales pitch there, Peter. Talk to us about the margin story, the profitability then. At what point can you start to raise prices for your vehicles and start to push margins out of negative territory?
Well, we've been able to bring successively more attainable products to market, where our range now starts at just $69,900. And we're able to do that because we've got the most advanced technology in the world. Let me explain. We're able to go further with less battery energy than anyone else. I recently announced that we hit the magic 5 miles per kilowatt hour landmark, and we're going to reveal a product which achieves that very soon. We're actually at 4.74 miles per kilowatt hour here today with our pure electric vehicle. Now, that pure variant has a range of 419 miles, more range than anyone else in the marketplace, but it does it with just an 88 kilowatt hour battery pack, and that makes it the most sustainable vehicle on the market today. Any journey you take, that car uses less electricity to go from A to B than anything else in the world today that's on the mass market.
Okay.
And that means we can have less minerals, less dependence upon mines around the world, less dependence upon sources of lithium, nickel, cobalt. And this is what the world needs: more efficient, more energy efficient, and more high-tech EVs. And Lucid is leading the way in this respect.
Okay, 5 miles per kilowatt hour, as you say, a magic number, a landmark number, as you've described it. You are, of course, backed by Saudi Arabia, the Public Investment Fund of Saudi Arabia, to the tune of about $6.4 billion US. Is it fair to assume that you're going to need to raise a similar amount, around the $6 billion level, to push forward into the future? Is that about an appropriate number to be thinking about in terms of future funding?
We haven't guided on the actual quantum, but let me tell you, this is a capital-intensive business, and we do need to raise more money, and we will at opportune moments in time on the future. Our vision is to be a major player here. The SUV this year, and we've got the mid-size platform coming late 26, and that's going to be a high-volume vehicle, mass-produced both in the US and in Saudi Arabia.
And you've talked about being in this for the long run with the PIF, with Saudi Arabia. Is there a line that they draw somewhere, Peter, where they say, okay, this is enough?
Look, they're the perfect long-term partners. We share a long-term vision, and we're mutually incentivized for success. They want this as much as I do. watch this space. They're in for the long term. And this transcends a mere financial investment. We are a cornerstone of them realizing their bold Vision 2030, where they transitioned their quintessential fossil fuel economy to an environmentally sustainable economy.
Okay. When you say watch this space, something's going off in my mind suggesting that maybe they're going to come through with another check soon from the Saudis for the business. Talk to me about the deal you did with Aston Martin, because it's interesting. So you've licensed some of your technology to Aston Martin. Talk to us about the consequences. They have delayed their EV. Does that have an impact on that deal? Does it have an impact on Lucid?
Very mildly. But the deal is very strong. It secures them a high-tech electric technology for the next decade. We're supplying them with modules for the battery pack, our Wonderbox charging, two-way charging technology, and our Sapphire drive units. These are the world's finest drive units, and it's appropriate that Aston Martin gets the really top-end stuff from our range, the hypercar, high performance. If you look at the future, though, it gets a lot more exciting.
Were you disappointed that they delayed their EV?
Well, absolutely. Any delay in any EV is less than ideal, but it's going to come, and we have secured their electric hypercar future for the next decade.
Is that a template for other licensing
Absolutely,
deals?
I hope it is, and it's actually initiated a lot more interest. We are in discussions with others, and when it gets really exciting is you look at the technology that we're developing now for a mid-sized platform for late 26. That really suits mass market family car applications. That's why we're in this. We're not here to be a niche player. Lucid's here to bring down the cost of electric vehicles for the benefit of all and be a major player.
And Rivian doing an interesting deal with Volkswagen. Indeed. Investment from VW into Rivian in exchange for some technology. Yes. Is that something you would consider, that kind of partnership, that kind of deal?
I'm always interested in partnerships which involve our technology.
Okay. We talked about the Gravity, the SUV, coming online. You talked about production at the end of this year. Deliveries next year then. What about manufacturing in Saudi Arabia? That's part of a process outside of Jeddah. You're putting the car together there, but in terms of full-term manufacturing in Saudi Arabia, when does that come online, and what is the challenge in Saudi Arabia? Is there a challenge around talent?
There's always a challenge around talent, because as a company, we're only as good as the brain power that we can attract. No company in its own right has experience. It's only the brilliance of the employees that represent the capability of a company. But we already have the very first car plant operating in Saudi Arabia. Right this moment it is running, and that is a kit assembly plant on a very modest scale. We are actually laying the foundations for our major plant, which will be scaled for 150,000 unit capacity per annum as we speak, and that is scheduled to be ready for production late 26, where we'll put our mid-size vehicle into that plant.
Okay, Peter Rawlinson, thank you very much indeed. CTO and CEO of Lucid, on not wanting to be a niche brand within EVs and hitting that 5 mile per kilowatt in terms of the range for their vehicles. Looking ahead, of course, to the SUV as well, the Gravity. Danny, Manus, back to you.
Tom, thank you very much. Sitting in a cornfield there. No better backdrop for an EV conversation. And have the Saudis got their checkbook out? That's the question, Tom. Great conversation. Danny and I will take you through what you need to know for the rest of your trading day in just a moment. This is Bloomberg from a radiant City of London.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
Let's get you set up for your trading day on this Thursday. We're going to get earnings from PepsiCo and Delta before the bell. Then the big data point, U.S. CPI, comes out at 8:30 a.m. Eastern, 5:30 p.m. Biden will be holding a news conference, which his team is taking the language from our Justin Sink, calling it the big boy press conference, Manus.
It is, and this is the whole point, isn't it? I think you said this, we were just chatting on IB. This is live. This is the non-contained TV interview. Can he deliver when you're losing George Clooney, when Nancy Pelosi's, not exactly fully behind you, and Senate people are coming out against you?
Yeah, he's got a big schedule coming up, Manus, so he says presser today. On Monday, he'll have a sit-down one-to-one with Lester Holt. Again, it's getting him out there trying to prove he should still be in the seat of power.
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, Well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
At the end of the day, what's going to drive the Fed in the next 3 months to September is inflation.
The hope would be, of course, that rate cuts would be forthcoming. We do think that that's going to happen and that inflation will moderate.
You can't really signal that rate cuts are coming until they get at least one more good inflation report.
I think what will cement September is really another round of data and, more importantly, what we see in terms of the inflation data.
They're planning to cut. They are reluctant to cut because they know how insidious inflation can be.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Your equity market negative on the S&P 500 by 0.1%. The S&P, the daily winning streak stretching to day 7. That is the longest stretch of the year so far. Can we add some more weight to it? The fate of this market in the hands of this right here. Your lineup is absolutely packed. This is what it looks like. 6:30 Eastern Time. Numbers drop from Delta. 2 hours later, CPI in America, a read on U.S. inflation. And then, Lisa, for many people, the bigger one might be later on this afternoon. 5:30 Eastern Time. The president holding a news conference.
I thought you were going to say, let's get your week started, because in some ways the week begins today. It is going to be really important. I think CPI, a lot of people are looking at as sort of determining the threshold as to whether the Fed is basically locked in for a September rate cut. We heard from Fed Chair Powell yesterday. But really at 5:30 p.m., I got to give Anne-Marie a bone here, because truly that is going to set the tone for a race that has been more unexpected than many people had imagined.
AMH in Washington, D.C., joining us in about 10 minutes' time. Look out for that conversation. It was another bizarre day in Washington, D.C. Let's just go through some of the headlines together. On the record, I'm for Joe. That's what the Senate Majority Leader's got to say, Chuck Schumer. Off the record, behind closed doors, apparently according to Axios, he says he's open to replacing Kim. It gets even more bizarre. Former Speaker of the House, Nancy Pelosi. The president comes out and says, I'm the nominee. I'm not dropping out. And Pelosi says we've got to wait for him to decide. It's almost sort of like childlike stuff, right? If you don't like the answer you've heard, keep asking a question.
Okay. I listened to this several times, actually, this interview, because I really wanted to understand whether there was any other way of interpreting what she said other than she just doesn't want to say, please leave the race. There were a number of things that I took away from it. First of all, she wasn't throwing her support behind him. That was clear. It was in response to the question, do you support Joe Biden to remain in this race for president? She said, I support him for making the decision that he wants to make. And then the host said, well, he made the decision. And she said, we just all love him and hope he makes a decision.
A different decision.
Exactly.
So these are the times and dates in the diary now. So what we're looking forward to is a news conference a little bit later. The bar is super low for that. We saw the announcement yesterday, NBC. There's going to be an interview on Monday here in the United States. I find it interesting that we've pre-announced that on Wednesday, yesterday, looking ahead to Monday. I just wonder if they're just trying to push this off. Just say, just wait till Monday, just wait till Monday. You get closer and closer to the Republican convention. You hope that President Trump gets back in the news cycle, announces a VP, and this all goes away. Fact of the matter is, this has been in the news cycle for a long, long time. It's not going away.
I was reading yesterday about why there seems to be this sort of coalescing around Joe Biden by a lot of Democratic officials, even though in private, a lot of them are very concerned about their chances about being reelected. And it's not so much just falling in line and blindly following, as much as if he says, I am not going to drop out, period, full stop, but it is his decision to make. Do they do more damage to their chances of getting reelected and to the party by simply going out against him and speaking their mind? And that's sort of the calculus that an increasing number of people are basically making. The dam is breaking, though. You've been saying that. George Clooney reiterated some of that in a Washington Post op-ed. The dam is breaking because it's gotten to the point where people are feeling desperate and they feel like this is somebody who is quickly deteriorating.
So I never thought I'd sit here and be talking about George Clooney. Typically, like the rest of you, I'd put no weight on this whatsoever. But actually, it was refreshing that someone who's actually seen the president behind closed doors actually said what we can all see in public repeatedly and saw in the debate a few weeks ago.
Basically saying, we saw in the debate a guy who I saw again in private during one of these fundraising campaigns. It's not an anomaly. And that's essentially what he was saying. When people talk about the elites versus the rank and file of the Democratic Party, there isn't really an apparatus in the Democratic Party for the rank and file to really speak, other than some of these donors, et cetera. And so you have to go to the polls, and when you talk to Democratic officials, they say, we don't believe in the polls, we're trying to change the polls. It becomes a sort of tautology that is very hard to get your hand around.
Quite a day we've got lined up for you. It starts in about 25 minutes when we get those numbers from Delta. This is what the price action looks like. Let's start with the scores. On the equity market, on the S&P 500, coming into Thursday at record highs. Equity futures pulling back just a touch. We're down 1/10%. Yields are lower by a single basis point. The 10-year, 427.63. And the euro stronger for a second session, 108.48. Coming up this hour, we'll catch up with Russ Kostrick of BlackRock as the S&P 500 winning streak rolls on. Ed Mills of Raymond James with mounting pressure on President Biden to step aside. And Michael Pond of Barclays with US CPI data on deck. We begin with our top story, another record high for US equities and another warning. Russ Kostrick of BlackRock writing this. On the equity side, we have moderated our overweight position, particularly some of the high flyers where positioning has become more crowded. Russ joins us now for more. Russ, great to catch up. We've got a lot to work through, including CPI 830, but let's just get into that call. What prompted the change of mind? When we talk about the high flyers, is there anything beyond NVIDIA? What kind of names are we thinking about?
Good morning, Jonathan. So, look, I should say at the beginning is we are still overweight stocks, and our base case is still that equities will end the year higher than they are today. We have taken some chips off the table, and I think there are a couple simple reasons. First of which is you have a lot of good news discounted in. We expect a strong Q2 earnings season, including for many of those high flyers. But the main point is that crossbar has been raised, and expectations have become very high. Even when you have a beat and you have strong guidance, you can still see some disappointment as some of these trades around, whether we're talking about semiconductors or some of the other areas that are very geared to the AI trade, have just run an incredible amount. So again, I think there'll be an opportunity getting these names as we get through the back half of the year, but we are in a point where it's going to be a little harder to beat and to impress the market than it was 6 or 9 months ago.
So, Russ, just to be super clear, this is an earnings call. It's not about the incoming data, what's happened at employment, what might happen with CPI later, how the Fed's going to respond to it. This, for you, is about earnings.
I think it's a sentiment call, the way I'd frame it, because I do think the earnings are going to be strong. We're confident a lot of these companies are going to continue to beat and guide higher. But again, the crossbar's gotten really, really tough to go over. And when you have companies and stocks that are up 30, 50, 70% in a short period of time, what they've got to demonstrate to investors becomes very hard to beat.
Russ, I'm trying to imagine what this call looks like in a practical sense. Is it basically sell NVIDIA, wait for it to fall 20%, and then buy it in those 2 months where it falls 20%? Is that basically the call?
I wish it was that simple. I think there are a couple of things to say right now. I mean, one of which is when you go beyond the stock price, also thinking about how can you wear your exposure. One thing that is very cheap right now, and there aren't as many given how far the markets run, is volatility. We still have a market where realized volatility over 1 month is in the bottom percentile we've seen over a number of years. So one of the things you can do, again, it's not just a matter of you sell it, you try to buy it back. Can you take some of the exposure off the table by selling some upside, by thinking about stock replacement, owning the calls or a call spread, rather than owning the stock outright? And what that does is it allows you to use that cheap volatility in a way that mitigates some of that downside risk.
Interesting, at a time when we have a lot of uncertainty in terms of what the macro backdrop and the political backdrop will be. I do want to get to CPI. You do see this as a pretty important data point that we get in about 2.5 hours' time. Some people are saying that it will determine whether the Fed goes in September or not. What's the sort of break-even rate, right? What's the sort of level that we have to see in the CPI report today that would either make or break the idea of a September rate cut?
Lisa, I'm not sure that I would describe any number, even, something's important, the CPI is the number that will determine what the Fed's going to do. It's, worth reminding ourselves that we're going to get 2 labor market prints, 2 non-farm payrolls between now and the September meeting, and those are also going to be important. The Fed has been very clear. They're looking at the labor market. They're watching for signs of moderation. So I don't think it's one number, but, our view is you're probably going to come in around where the consensus is. And I think there's going to be some focus on the service component, the housing component, the parts that have been a little slower to come down. I think if you get in that ballpark of the consensus around 0.1 on the headline, 0.2 on the core, that's going to help solidify the case for a September cut. But again, I'm not sure that any one number is either going to, nail it down or reject it.
For the purpose of this conversation, Russ, we can make a couple of assumptions. Just for the purpose of this conversation, let's just say it leaves the door wide open for cuts in September and maybe beyond. Let's also assume that in the next month or so, employment continues to weaken somewhat. Cool, if that's your favorite word. I want to understand what the limits are to the rally at the long end, given the political considerations that have been percolating now for the last couple of weeks.
Yeah, John, I think this is exactly the right question because honestly, the market has already gotten to the point where you're likely to cut 2 times this year. And I think that's probably about right. Certainly a lot closer to what we're going to see than how we started the year. But we're still in an environment where you've got a couple of things to keep in mind. The volatility of inflation is much higher than it was pre-pandemic. We have got considerable concerns about the amount of supply we're going to see in the back half of the year, 25, 26 and beyond. And by supply, I mean the supply of treasuries. So even if you get a benign print today, I still think we're in an environment where the long end, let's talk about the U.S. 10-year, is probably still in a trading range, which has been roughly about 420 to 450. That's probably a reasonable range going forward, even if we get the print the market's looking for today.
Yesterday, there were $39 billion of 10-year treasuries that were sold at a time when a lot of people are raising these concerns about long-term inflation and the ability for longer-term rates to come down. Given the deficit, it was a rip-roaring auction. It did fantastically well. The indirect and the direct bidders really increased. The proportion taken down by the dealers decreased, and it was a below-market yield when it finally priced. Russ, is this noise and not signal?
Well, I think any one auction is probably noise, but, if you take a look at the broader, let's call it the last year, we have had auctions that have tailed. We have had auctions that have not gone as well as expected. And we are realizing that the structural deficit we're likely to see going forward is going to be high and probably higher than we thought 6 months ago. So while it was a relief to the market that you had a good auction yesterday, we're going to have this come up again and again and again. And, again, if we think about, we weren't talking about this 3-4 years ago. This is something that really has come up in the landscape over the last 9 or 12 months. I don't think we're